I request Chairman Sri Rinkesh Shah to take the faculty on the dais, Mohanty sir, Rajesh P. Shah sir and Rutvik sir, and our today's moderator, Soumya City sir. May I request all of you to stand up for the ICAI motto song.
य एष सुप्तेषु जागृति य एष सुप्तेषु जागृति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यति कश्चन एतद्वैता 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 एतद्वैता.
Now I request Chairman Sri Rinkesh Shah for providing their opening remarks.
Good morning, sir. Today is the last day. Today is the last day of the FEMA series, and we kept a panel discussion. So when the faculty came and we were discussing, so I just told that, sir, it is like a time when a student is giving a exam for 3 hours and he completed paper in 2.5 hours, and within last half an hour when he is reviewing and correcting himself wherever he feels necessary. So this panel discussion will be like this. For the 10 days continuously, we try to learn as much as we can, and we try to interpret at our own language or own knowledge whatever is produced by the respective faculty. And today's learning faculty will refresh those stuff which is given in the last 10 days, and we will try to judge whether our interpretation was correct or wrong, or if it is misunderstood, we can correct ourselves by asking the question. Respected Mohanty sir, learned faculty, we called RBI itself, right, for the Mohanty sir. Thanks a lot for coming to Ahmedabad branch and giving us the opportunity. Rutvik sir, thanks a lot for coming to Ahmedabad branch. Yesterday your father addressed us and and he announced publicly that this is the last session in Ahmedabad. So we are fortunate that we got this opportunity to have interaction with him. Rajesh sir, he also came all the way from Mumbai to address us. Friends, when the series was launched, all the faculties were decided. We did not decide any faculty for the panel discussion. The reason was that it was not like that we were confused whom to invite. We had in the mind that this faculty should come. But the point is that this faculty were not available, and we are trying to pull them that you should come on the 11th day at any cost. So that's why we did not mention in the brochure, but we were behind them to, me, Jai sir, Sanskar bhai, Dipen bhai, Soumya bhai, were behind them to, at any cost you have to come to the Ahmedabad. Friends, respected faculty, I would like to draw your attention that more than 125 participants have registered for 11 days. And when the series was started on the first day, we opened for the, daily basis registration. And every day we are getting 20 to 25 registration additionally. I know this hall is not occupied, or the number which I am saying this you cannot see, because it depends on the breakfast menu. If the menu is good, then people are coming little late. So, it depends. That I think today menu might be a little bit, exciting. So people are enjoying, and you can, before we start, one by one, people will add. Participants, again, I request tomorrow morning there is a session on the Gulf country. Please do attend. We have already launched FAFD course yesterday, forensic accounting and forensic, so if we want to do, after a long time, it is to be hosted by Ahmedabad branch. We are getting a number of requests from the participants for the different stuff. We are going to have the workshops or the one-day conference for the various opportunities available at the gift city, and what kind of categories of the funds are there, category 1, 2, 3, and other stuff. So we are going to have that one-day conference also. So again, rest assured, feel free to connect me or any of the committee member for any of the opportunity you would like to have at the ICAI Ahmedabad branch. We will try at our level best. Thank you. Thanks a lot. Enjoy the last day. I will come again at the concluding remarks. Thank you. Thanks a lot.
It was great to introduce all the faculties today. Today's session chairman is Mohanty sir. Mohanty sir is a senior advisor with PwC and Co LLP. He has over 30 years of experience with most of his career spent at RBI. He has worked in the several areas, like he was the general manager and foreign exchange department with them. He was involved in drafting and implementation of the significant amendments in the RBI policy and the framework. In this note, we welcome you, sir. Today's our second faculty is, I request Chairman Sri Rinkesh Shah to provide memento to the sir. Our next faculty is CA Rajesh P. Saab. He is a partner at Gentilal Thakkar and Company, and he is a partner of Pilike Thakkar and Company. He is over 15 years of experience in the FEMA and the international tax. In this note, I request CA Chairman Rinkesh Shah to facilitate with the memento to Rajesh sir. Today, third faculty is C. Rutvik Sanghvi. Rutvik Sanghvi is a chartered accountant with more than 15 years of post-qualification experience and partner at Rasmi Sanghvi and Associates. He represents regular various fora, including the Institute of Chartered Account of India, BCS, CTCS, and he has co-authored the publication on the disclosure of foreign asset and foreign incomes and analysis published by BCAS in July 2023 and reprint in the September 2025, and contribute to the latest edition of Sampath Iyengar commentary on the income tax law as part of the editor's team. He is regularly contributes articles in professional journals and compendiums. His articles are available at their firm website also. On these remarks, I request Chairman Shri Rinkesh Shah to facilitate with the memento to the faculties. Today's panel discussion moderator is C.A. Soumya Seth. He has also taken a lecture on the ECB in the current curriculum. He is a partner at BGSS and he is involved in FEMA work from the last more than 10 years. On this remark, I request Chairman Sri Rinkesh Shah to facilitate with the memento to the Soumya Sir. Now I request Soumya sir to take up the charge of the session.
So, friends, we begin today's session on panel discussion on various case studies on FEMA. So the way we have structured this entire session is that you must have got various case studies which have been circulated to you. We will not, different panelists are there, all three panelists will be addressing each of the case studies. Now we will directly go on the case studies and not explain the entire facts, because that will save time. Each one of you have the printout with you, I believe, have read the case studies. So we'll directly go to the question involved. Each of the panelists, we have allocated different case studies to different panelists. So they will take case studies, give their views on it, what are their views on it. If any other panelist wants to supplement those views, they will supplement those views. And then on that specific topic, so we have different topics, topic-wise case studies are there. Once that topic is over, if any of you have any specific question relating to that case study, for example, LRS, ODI, FDI, etc., you can ask those questions related to those topic only, not anything else. So that is how this entire case studies will be over. Once the case studies are over, at the end, we will ask each of the panelists to share their practical experiences on their day-to-day lives relating to this FEMA. So with this, we begin this today's session. The first will be opening remarks by Mohanty sir, as Jay mentioned that he has been a faculty member or he was part of RBI. So we will get an inside view of the RBI, how RBI thinks, how RBI reacts, how RBI views a different matter from RBI's perspective. And remaining two are stalwarts in their fields, in the field of FEMA. They are practicing or breathing FEMA day in and day out. So that is how we have this entire combination of both the perspectives, the practitioner's perspective or the client's perspective, as well as the regulator's perspective. So we will get a complete picture, a 360-degree view of FEMA today. With this, I kindly request Mohanty sir to give his opening remarks.
Good morning, everyone. At the outset, I must express my gratitude to Rinkesh Bhai, Soumya ji, and the Ahmedabad chapter of the Institute. The Institute for inviting me here. You see, I have been in this field for a good number of years, 45 years to be exact, more than the age of most of the people. I joined Reserve Bank in 1982, and that was the FERA regime. So my initial working was in Exchange Control Department, as it was called at that time. So over these years, I have participated in many of these interactions with chambers of commerce, the institute, the training establishments of the banks, and of course, a cross-section of these kinds of things. RBI used to hold a forex for you for some time. Even now it is holding so. And I always find these interactions very illuminating, because there are many problems, as will be clear as we discuss. There are many problems which the regulator does not know unless it is communicated to them. I have interacted with his father, Raswin Bhai, who was yesterday and spoke to you about trust and things like that. So I always used to tell my department people that you interact with the people so that you know what are the kinds of problems. And this interaction is very helpful for RBI to frame rules. At least I found that during my time, there are many problems which the RBI does not know about. I mean, I sitting in an RBI chair would not know about what is happening or what kind of changes are needed. So now, as you know, FEMA is a very simple act. The operating sections are very few in number. In fact, I would say some 3 or 4 sections, section 5, 6, 7, 8, and 9. The rest are all, basically about enforcement, administration, the authorized dealer, and so on and so forth. Now the devil is in the details. With all the regulations and rules which have been framed over the years, And there is no consistency. You see, you would see that this thing, the evolution of the regulations and the rules has been, I would say, consistent with the times, but not over time. At this point of time, as I speak, we are going through a crisis. Yesterday, the dollar had reached all-time high, rupee all-time low. And obviously, in that kind of a situation, what the regulator thinks is that how to arrest that slide of the rupee. And how do you do that? You do that by encouraging dollar inflows and discouraging dollar outflows. So now you will perhaps see, if this situation continues, you will perhaps see a slew of measures which will be directed towards that, how to encourage inflows and how to maybe something like a swap that we did in 2013 or the India Millennium Deposit that we did in 1999, something like that is also possible. RBI is discussing about that. It is also possible that there will be restrictions on LRS remittances. Of course, now it is a small part of it, but then those remittances. Now, for instance, this takeover by Sun Pharmaceuticals, immediately the response is $12 billion. That will it mean outflow of $12 billion? So when it was explained, no, it will be a small part of it. The large part of it will be mobilized outside India against the security of organon. Then, there is some amount of comfort. So now you will see a slew of measures. And we have passed through many such phases. I am seeing this since 1982, when it was very, very restrictive. Then it became liberalized. Then 99 came, FEMA was put in place. Then after that, soon after that, you had this Pokhran problems, and then we had some kind of policy changes. Then we were inundated with inflows in 2006 and 7. So that is when this NRO 1 million was put in place. That let people take out money. That is when LRS amount was increased to 200,000. So that is when all kinds of things because when we are getting a lot of inflows, so you try to make policies so that money goes out. After that, in 2008, the layman happened, and after that, rupee depreciated. Rupee had come from 46 levels in 2006 to about 39 levels by early 2008. And once layman happened, it went back to 52. And when it went there, and then after that, there were a series of events. Layman happened, then the debt crisis in US, what they call taper tantrum. So there was a problem, and then you saw some, measures to stop outflows and increase inflows. You see, that is when your LRS was brought down to $75,000. Your overseas investment was brought down to 100% of the net worth. So some such measures, ECB permissions were not given. Okay. So these kinds of measures were taken. So basically, FEMA has been evolving in response to the time. Whatever if you see the preamble of FEMA, it is basically says two things. To facilitate trade and payments, yes, but also preserve orderly conditions in the forex market. So if you see volatility in the forex market, then obviously there will be a policy response. RBI tries to intervene, but then there is a limit to intervention. If you buy dollars, there is a cost. If you sell dollars, you only have so much, how much you can sell. So therefore, intervention only serves up to a purpose, buying or selling of dollars. And after that, some of these measures will come. Now what has happened is, what the policy makers, what they are thinking is, over the last 3 years or so, the net FDI flow has been negative or has come down very significantly. Now, it used to be about $70–80 billion 3 years back, and now it is minuscule or negative. There is a lot of outflows. There are several reasons for that. And today morning I was seeing in the paper, the FPIs in the first 4 months have sold more than the entire of last year. So that is one kind of outflow. The second outflow is the private equities downloading their stocks through IPO. Last year, there have been a record number of IPOs, so that is one of the reasons. FDI flows are not coming, so various kinds of things. And now, our current account deficit is increasing. There is so much of gold import. There is so much of oil import. Current account deficit is increasing. Earlier, because we were getting a lot of capital inflows, we were not able to notice. So that is what is happening. That is why rupee is depreciating. So the policy will always be, you can say that it is agile to respond to those situations. So that is one thing that we must foresee. And we must, take that into account when we shape policies. The other factor is that FEMA is one area where you do not have enough case laws. You see, when you give an opinion, what should be done or what should not be done, unlike income tax, those who are, and all of you, I believe, in some way or other are dealing with income tax. Income tax has got a rich, stock of rich repertoire of case laws. There are income tax appellate tribunal orders, there are court orders. But in FEMA, there is not much of it, because FEMA is one area where there is not much litigation, not much case laws. So to take a view is very difficult. And what I was telling, in FEMA, you see, no matter how detailed RBI wants to be, there still will be situations which will fall in a gray area. And we will see there will be plenty of areas which fall in a gray area. In those gray areas, how do you take a view? While framing the law, RBI had certain things in mind. So they did not address a situation which you may come across today. I'll give you one example. You have had a session on ECB, you had handled. Now, ECB, the earlier position, the ECB regulations have now been changed. The earlier position was that if you borrow money, it cannot be used for in capital markets, real estate. Certain restrictions were there, negative restrictions were there. Then the question is, what is capital markets? RBI has been taking a view that capital market would mean buying of any securities, listed or unlisted. That means, although this is a debatable thing, because capital markets ordinarily would mean the stock market, the listed, quoted, traded stock market, because we don't want borrowed money to fuel any asset price inflation, stock price inflation. But RBI has been taking a view that if you get into any equity, then that is not allowed. This has been there for quite some time. Now, there is an investment opportunity in the erstwhile Schedule 5 of FEMA 20. That is, the foreign portfolio investors are allowed to invest in NCDs, corporate bonds of companies in the market, listed. Originally, it was allowed only in the listed securities. Subsequently, in 2017, they allowed in unlisted securities also. Now, these listed securities, if the FPI is buy, there is no restriction on end use. Because the way RBI thought, or the way RBI thinks, is that this is not possible. When an FPI is coming and buying us NCD in the market, it does not know why the NCD was issued. NCD could have been issued yesterday or could have been issued 5 years back. So why it was issued and where the proceeds of the NCD were used, the investor doesn't know. So therefore, there is no end-use restriction. Now, somebody takes advantage of this, a multinational company, let us say, which has got, its associates all over the world. A company in one of the financial centers, maybe Netherlands, London, Singapore, somewhere, registers as an FPI. This entity issues a NCD, this Indian entity issues NCD of, let's say, 1,000 crores, 5,000 crores, gets it listed, then goes to the foreign entity, becomes registered as an FPI, buys out all the 5,000 securities. Now, will it constitute a contravention or not? Because this is a bilateral transaction. This is not a market transaction. So because there is a gap, you are trying to take advantage of it. Now, the courts have held that what you cannot do directly, you cannot do indirectly. Even if the law sometimes permits some certain things, if it could not be done directly, you cannot do indirectly. In FEMA case, Supreme Court has said this. So therefore, now the enforcement authorities are saying that this was a contrived action and should be subject to prosecution. So these kinds of gray areas are plenty. So we should be very careful about, while doing a transaction. Of course, it depends upon the risk appetite of the client, risk appetite of the investor. I mean, how much, if it is in a gray area, then whether they want to take a risk, so that is up to them. But then we must, at least in our advice, we must be very clear about this. The next thing that I would like to say is that ultimately, the Reserve Bank normally does not give any clarification. So if there is any doubt, so you can go for a permission. I would always suggest that if there is a gray area, it is better to have a permission rather than take the risk. Of course, anything can be compounded, but the problem is that compounding is subject to penalty. Compounding can, in certain situations, be subject to recovery of undue gains. That is, if you did something which was not permitted and made some gain out of it, then that gain can be recovered in the compounding process. And this has also been done, running into tens of crores of rupees. And third thing is, most important thing is, RBI will not compound a matter unless the irregularity has ceased to happen. If the irregularity is continuing, then they cannot. So that will mean undoing the damage, undoing the contravention, and which may be very expensive. For instance, if you have made an individual investment abroad and it was not in order, and then you have to corporatize yourself in India, then you run the risk of tax payment, which can run into many, depending upon the scale of transaction. So these are things which we must always keep in mind. And we'll discuss the cases, whatever has been listed out, and the case, I mean, whoever has done this has done a very sound work, because they have given not only the question, not only the situation, the question, they have also given kind of clue to answer. I mean, all the material for discussion. So thanks to your effort. And we will discuss these questions. But as and when you have anything to add, any question to ask, please do that. Let it not be a one-way avenue, because there is nothing finality about many of the things which are in gray area. So anybody can contribute. So please do that. Thank you. We can start it.
Thank you, sir. So we will start with the first case study. The first case study is case study 1, residential status of students studying abroad and relating remittances. So with this, sir, your views on that?
Okay, very good.
Yeah. So there are two questions. We'll directly go to the questions, because I assume that each one of us has read the cases and the facts. The queries are that whether Mr. A, who is Mr. X's son, will he be considered, who is an engineering student working outside India, will he be considered as a non-resident or not? Reference to RBI's APDIR circular number 45. And what funds can be transferred to a non-resident with control remaining in India.
Okay, I hope you have gone through this. I'll just briefly summarize this, the situation. There is a Mr. X in India who is a resident. He has a son who is an engineering graduate and works in the firm. The son will go abroad for higher studies. Whatever period, whatever course duration, maybe a year and a half. And then the plan is that he will come back to India after that. The first question is that when he goes out as a student, will he be a non-resident? RBI, some circular was issued in 2003. That reference is given. You see, in our early days, in my early days at least, from 82 till 2003, students used to be treated as residents. Because what was the definition of residents or non-residents? If you have gone out for employment, carrying out a profession, or things like that, which shows intention to stay for uncertain period of time, right? If you go today, and which shows that you are likely to stay there for an uncertain period of time, employment. So this was what was the legal definition. The IMF definition, according to which balance of payment is compiled, and then it says that where your center of interest is. Center of interest will basically mean where you are earning your income. So that is how they define resident and non-resident. Now, till 2003, it was thought that these people who are going abroad, they are going abroad for a definite period. The course will, of course, not run into uncertain period. It will be 1 year, 3 years, 5 years, whatever they're going for. In most cases, or in almost all cases, they did not have any income there. Right? So therefore, they were treated as residents. In fact, when RBI's people used to go for inspection, if any NRE account, those days, NRE account used to carry 2% more interest rate. So if NRE account was opened in the name of a student, that is your F1 visa, so they used to book it as an irregularity. So this was the situation. In 2003, Mr. Narayan Murthy was on the board of Reserve Bank of India. So he said a very important thing, that nowadays when students are going, they have income. Most of the time, the students who are going abroad for doing MS, PhD, or any MBA, any kind of course, they have income. So your classic definition that student who is going abroad is mostly going on his father's money is no longer true. So you give them some benefit to have, these NRE accounts. Even those days that interest rate differential was there. So you give them some benefits. So this argument RBI bought, and in 2003 this amendment was there that students will be treated as non-residents. So as on today, students are being treated as non-resident. Again, now there is some thinking, rethinking going on, depending upon the situation. What will happen tomorrow, we don't know. But as on today, students are treated as non-residents. Now then what happens, this is the clean part of it, there is no problem. Then the problem starts. X intends to transfer around $1 million to A before he leaves India for his studies abroad. So before he goes there, he transfers $1 million to his resident account. So this is a gift, father to son, no issue at all. No law prohibits it, no taxation, nothing. Then once A goes outside India, what he will do is that NRO account 1 million I spoke about, so he will have it remitted outside India. Then this will be invested by the son into some whatever assets are available in US. Okay, it may be buy Google shares, buy whatever, including wants to acquire a property also, I believe, sir. Okay. So, but the control will be with the father. So whatever portfolio is built by the son using this 1 million, you see, technically there is no problem so far at all. 1 million is gifted, is perfectly all right. So that money is there. It should not be borrowed money. That 1 million should not be borrowed money, but it is gifted. So as on date, the day he has gone, he already has that 1 million in his bank account. So the law permits the NRI to have 1 million, up to 1 million in a year remitted from his account. That also is all right. Once he remits it, what he does, there is no end-use restriction, so he can build a global portfolio. There is no problem in this. But then he says that X controls it. This is a little bit of a problem, because if it is a portfolio, then how do you control? If you give me investment advice that you buy Reliance shares or this thing, so you are not controlling it. Ultimately, I am carrying out. Control will come only in a corporatized structure. The one who has the maximum voting power, the one who has ability to direct majority of. So controlling a portfolio, this is not something which can be translated into law. Unless the money is transferred to the father, and who is managing his portfolio. So otherwise, he managing the portfolio on behalf of his son does not have any legal connotation. So he can do that, there is no problem. He can always give direction to his son that do this, do that, sell this, buy that. So there is no problem in that. So X is paying the fees by borrowing from his friends, banks, whatever. So there also there is no restriction. If you are, obviously that money that the father will send abroad for the education expenditure will be current account transaction. There is no restriction on current account transaction funded by borrowing. In fact, all the students who go abroad for studies, they borrow from the banks, or their parents borrow from the banks. So that is not a prohibited thing, provided it is a current account transaction. What is not permitted is you cannot borrow to create a capital account asset. Now, A wants to buy a property on loan there, take a mortgage there, repayment of which will happen once he is back in India from his Indian sources. This also RBI has permitted. There is, RBI said at one point of time, that when you are a non-resident, if you create any asset and then you come back to India, and then you want to repay for that asset, then you can do that, subject to LRS limits, of course. So this also can be done. But the whole story is a little, a risky proposition. Because tomorrow, as I said, what you cannot do directly, you cannot do indirectly. This can be said that you have contrived the whole situation for this purpose. Okay, ultimately what will happen to the prosecution and other things, I do not know. Because technically there is nothing wrong. But you run this risk that you have if you see the whole thing, you send your son, you give to $1 million equivalent, you send your son outside India, he takes out 1 million, he invests in whatever portfolios, and then he buys a property on mortgage, he comes back, and then you remit for this thing. So the whole thing seems to be a planned arrangement. So you run some risk.
Can I add something?
Oh yes, please. Most welcome.
Friends, as sir said, he joined RBI in 1982. That was the year when I joined the school. So FEMA, when it came, I was lucky that is the year when I graduated as a chartered accountant. So I started doing research on this. And FEMA subject, my senior partner Dilip Thakkar, being the pioneer in this field, gave us the case study. What we all forget in 2020, 25, 26, that this circular of December 2003, when it had come, there was no LRS. Sir, LRS came in 2004. 1 million scheme also came in 2004. So, somewhere in the year, the FERA was from 1973. Why this background is important? Because today we jump to the conclusion that what is right, what is wrong on the basis of this. Student was given this category of non-resident because what had happened right now, before the LRS, even to open a bank account, you required a RBI approval. So from the FERA regime 1973 to 1991, when the liberalization took place, and up to 1999 when the FEMA came in, you have to knock the door of RBI for everything. So the student who used to go abroad was always a resident of India. So as a resident of India, if any gift is being received, he has to bring it to India. He could not open a bank account without prior approval. And he could not do a part-time. So if you do a job part-time, that money also had to come to India, being a salaried person. So The whole representation went to Reserve Bank of India. As Monty sir said, come to RBI, come to RBI. We in our young days used to go very oftenly. 2 to 4 o'clock was considered, sir, as the best time to go RBI and meet the people in officials and discuss the facts of the case. So 2002, we presented to them that this is the reason why the student should be treated as an NRI. And yes, all this planning and all come later on. Reserve Bank of India, in a very rightful way, came out with this circular in 2003 when there was no LRS, no 1 million, and said, okay, students will be treated as a non-resident, so they do not fall in the category of contravention by accepting. So it is very common that when a student goes abroad for the studies, some fai, masi, je foreign ma rehta hoye, they gift it to them for the education and all. So this was all considered as a prohibited category because as a resident, they have to bring it back to India. So this is how this circular came in, and they were treated as a non-resident. And thereafter, being a non-resident, then all the planning of the professionals and all started, gifting it before becoming a non-resident and all. But sir, let me just extend this case study. Sir has said about the prosecution and all. We had a classic case of a 20-year-old daughter becoming a non-resident as per this circular, father gifting this $1 million, company opened in Middle East. This $1 million became $6 million in 3 years' time. When the girl was studying, the money was increasing, and then the money came back to India. ED issued a notice because the high volume of transaction came into India, and the girl was summoned. Please tell us, how did you earn this income? There is when she opened up everything, saying everything was being handled by my father. I was studying as an MBA and all. So the same state will happen of Mr. X son A, where 1 million is gifted, everything is controlled by father. So if there is any issue comes in, then all the contravention will take place. Prima facie, this is permissible, gifting it to son, 1 million and all. But at the time of prosecution, see, FEMA law, you will all see, yes, what is permissible, you will be doing it. Sir rightly said, what you cannot do directly, you cannot do indirectly. This becomes the static tagline of the enforcement agencies. And the people who are sitting over here, if anybody has visited Directorate of Enforcement, they start with the thing that whatever the client has done is wrong. They will not even read to the FEMA and all. They go on the substance rather than the form. They don't go to the rules and regulation, because what Mr. A or X has done is absolutely fine with the law. But whether it matches with the purpose for which these things are there is the most important thing. Thank you, sir.
Right. Yeah. Can you hear me? Hello. Yeah. Thank you, sir. Yeah. Yeah. So, good morning, friends. Hello. I don't know which one is it. Hello. Hello. Sorry. Yeah. Good morning, friends, and many thanks to the organizers for this opportunity. I am, today is as much a learning experience for me as for you. So I am beneficiary on both sides of the table. No, as correctly pointed out by Mohanty sir and Rajesh bhai, nothing more to add as much as just to highlight, what both of them have said, that I would just put it in general that many times these kind of queries come to us. In fact, these kind of queries have been formed out of very live cases. So the, organizers have very thoughtfully put in these queries. These are cases which, as Rajesh bhai pointed out, he has handled it. Even we have handled these kind of queries. And point is, what he mentioned very clearly is the substance part of it. Each of these points may look as legally correct, but at the sum and substance of it, it will go down to the intent of why this whole transaction or what this whole arrangement was done for. What in tax law we call as general anti-evidence rule, which now, came in a few years back, in FEMA it has been there all along. And they actually apply the law in that manner. And what I think Mohanty sir and Rajesh bhai may have told it, in one manner, I will put it very clearly, RBI is only the administrator of the law. Enforcer is the enforcement directorate. So when the child has to answer these questions, you can understand what goes through them. I would genuinely request that if there is this kinds of arrangements, then one must be very careful before they proceed, because any of these steps may get countered away. And just to tell on the technical point of side, first of all, this 2003 circular is an exception to the law. As Mohanty sir and Rajesh bhai also pointed out, it's an exception to the law. There is no grounding today for this circular in the written law except for this circular. And that is why what Mohanty sir referred to, there may be a rethinking on this. Tomorrow maybe they may retain this with a different thing, or it may go out altogether. Irrespective of that, when we read para 4 of the circular, it clearly mentions that having regard to the circumstances stated above, it is clear that on both counts, visually they stay abroad for more than 182 days in the preceding financial year, and their intention to stay outside India for an uncertain period when they go abroad for the studies, they can be treated as non-resident. This is a cumulative condition, so even if a person has not spent 182 days in the previous financial year, at the same time their intent to stay outside India for an uncertain period needs to be met, in my view, as per this circular by itself. So I would probably say that there can be a good reason to say that this person has never turned non-resident just by going abroad for a specific 12 to 15 month course, where the facts say that he is going to come back to India immediately after that course. But that being said, yes, generally speaking, all students would become non-residents, otherwise they will violate FEMA from day one. And therefore this whole mechanism has been kept with that intent in mind. But when you utilize it to invest abroad, to have properties abroad, you will face a litany of questions when they come back to India. So that, I think that's what I just wanted to add, sir, and back to the moderator.
Yeah.
Any comments, questions?
Mike.
Any comments, questions, please?
Any implication after the Delhi FEMA tribunal ruling on the residential status, with this circular, there is a two prominent view available in the market. Key view one, we have to check the 182 days for the all of the things, and from the second view is we have to take 182 days from the property purchase transaction, and from the other transaction, we have to take the view to that it is a non-resident. So how we can club this thing, and how all the three faculties take on this vis-a-vis this thing?
That is something which everywhere it comes up. Basically, your question, as I understand, is this, that a person has come back to India. 182 days, he was last 182 days, more than 182 days of the last financial year, he was in abroad. So technically, he is a non-resident, you are saying. And so he has come back today and he has bought some agricultural land. This is the question. What is the
Non-residential.
Actually, this circular, that is when we go, right, it is a non-resident. So it is clearly mentioned in the circular. However, when we check to the residential status, right, there is a three condition and to the exception, 1, 2, 3. One is you go for the business and profession outside India. Secondly is the in material period. So there is a 12 to 15 months course. We have to identify that it is not under the uncertain period. So it does not fit under the first limb, second limb, third limb. So after the FEMA ruling, the change in the residential status viewpoint, right? So one view is that we can check 182 days only for the purchase of land or immovable property transaction, not for the all transaction. And remaining 182 days we does not consider for the banking or any other regulations. So how this circular is go hand in hand in this, so whether interpretation is changed after the FEMA rules or still continue with this circular?
See, one thing first, let us get it clear, and then perhaps your question, answer to your question will. This 182 days is meaningless. Don't read that part of it. When FEMA was being drafted in 99, This income tax people put that 182 day forcibly. It does not have any meaning. I'll explain why. Income tax is always a backward-looking thing. FEMA is a transaction-oriented thing. So what is it today? You want to remit $100,000 today. So what are you today? You are receiving any action you want to take. You want to make an overseas investment. You are receiving overseas investment. You are receiving a loan on a particular day. Income tax is always backward-looking. Last financial year. So for the purpose of taxation, today on 30th of April 2026, the Income Tax Department will see during the last financial year which ended on 31st March, whether you stayed in India for more than 182 days, in which case you are a resident, you will be taxed as a resident. If you stayed less than 182 days and stayed abroad for more than 182 days, then you will be taxed as a non-resident. FEMA, it is not like that. So that 182 days is completely eliminated. I'll give you one example. Harish Salve had a problem. As you know, he practices, many lawyers do nowadays, they practice both in India and in UK. So sometimes they have to spend here, sometimes they have to spend there. As far as income tax is concerned, they simply go by how long you were there, here or you were there. But FEMA does not go by that. So he had a problem that, last year, I stay in India, but have to travel to London for participating in arbitration, etc., etc. And last year, incidentally, I had stayed in London for more than 182 days. So do I become a non-resident? Okay, my answer to that such a question will be that no, you don't. Because you are staying here. That was a business visit. So even if you, let's say, managing director of a company in India, travels abroad for 360 days, he does not become a non-resident. He is going for his business. So therefore, FEMA is, if you have come back on 1st of April, the whole of last year you stayed abroad. 1st of April you came back for good, which qualifies under that. Practicing a profession, on a job, etc., etc. Then on 1st of April, you are a resident. You have come back to India. Irrespective of the fact that the whole of 365 days of last year you spent abroad. So today you are a resident and you will be entitled to do anything as a resident. Okay, of course, you will get exemption on 6(4) for holding wealth abroad, etc., etc. Those things will be there. But you can do everything as a resident. It will become slightly complicated if you are a foreign passport holder. It is, particularly in Gujarat, several times I have gone to this Saurashtra, Bhuj areas. So there are many African Gujaratis who come here and don't go back. They carry African passport, they come here and don't go back. So those days, every time the bank will say, what do we do with their NRE accounts? Because those days it used to earn 2% more interest. So they come here and don't go back. So these kinds of, but the day you come here for uncertain period, you are a resident. Okay. So are you satisfied now? Okay. Anything else?
Any other questions on this? Okay, so we can move on to the next case study. Yeah. Okay. So the next case study is something which probably all of you would have encountered in your daily life, that an Indian individual, specifically it happens more so nowadays. So I'll just briefly summarize for Rajesh Bhai to give answers. That Mr. A is a resident individual, is a director of a private limited company in India.
We can do that as per the law. As per the law, we are bound to invest there and earn money. There is no bound. But the another example, as explained by Rajesh Bhai, ED summons a person, a girl, and ultimately it happens that it is not allowed. So technically law says it allowed, substance over form says it is not allowed. But my question to you is something, how to overgo, how to surpass the substance over form. For example, a son is there, they have a discussion, they have some niece and uncles over there. Now the son itself decided that this is very good opportunity in Australia, okay, and he buys something over there on his own, and he take an approval from father that my friends are saying that, auntie is also saying that, and I would like to do so. Can I do so? Father say yes. Now tell me what is the substance over form over here? There is a yes of father and the will of a son.
I will give a reply. I hope that will rest this whole issue. Definition of non-resident has to be read how the FERA took over the years and how the FEMA continued. As rightly said by sir, FEMA goes on a particular date. So on a particular date, if you have come back to India and you have taken up an employment or something, settled in India, you become a resident from that particular year. Anything which is done in excess, the question what you raise right now is very simple. Okay, you want to extend, do something and all is all permissible, no issues. But whenever thing is done in excess, which doesn't meet the eye of law, then is where all the problems start. A person becoming NRI, taking $1 lakh from the father, doing some business, doing some investment, buying properties, all fine, no issues. But when this thing is done, where it doesn't meet the substance is where all the problems start. And when you do on a case-to-case basis, we as a professional will realize that something is being done is very ati kareli taklif tha hai. This is where we come to. And now when I come to the Pradeep Mishra's case, he tried to understand government is very protective about the land, agriculture, land and all. Why this all definition changed? Because sir, foreigners used to come and settle in India, take up an employment. On the date of employment, he become a resident of India. On a day he become a resident of India, he could be treated as a resident of India, could buy a property, immovable property, and the Goa whole thing became owned by the foreign nationals. When it came to the knowledge, there is where this definition got tweaked and this 182 days and everything came in. What needs to be seen is how the law is interpreted. This case of Pradeep Mishra, when he came to India, he became a resident of India. But then he started buying agricultural land from the money which was brought in from abroad and everything. There is where he wanted to bring a control over it, and hence this decision was passed. Everybody does this. When it comes to the knowledge of the agencies, Rutvik Bhai said that when agencies goes to the whole nitty-gritty is where all this problem. Anything which is done within the limit, within the framework will never have a problem. I hope that...
Yeah, that
Thank you.
suffice.
Thank you, Rajesh Bhai. Now we move on to case study 2.
So case study 2 is very interesting. Credit card. So all this started long back. Economic Times, what you are hearing. 16th May 2023, there was a notification. Prior to May 23, there was one more notification which said all credit card spend now will be part of the LRS. The who's and who's of Delhi went to Reserve Bank of India, sir, and they said that if LRS limit is part of my credit card spend, then in 1 month I will be exhausting my $250,000. So they came up with that 16 May 2023 notification saying, okay, till the election we are postponing it. Election ho gaye, 3 years are over. This is how the relaxation is given. But the most important thing which has come now is TCS. There is no TCS on the corporate card spend, whereas there is a TCS on the personal card spend. And the personal card, if spent from India, will be part of the LRS limit. If it is spent at the point of sales outside India, it will be outside the LRS limit. Now, so one important thing we as a professional has to understand is when we are advising a client, Gujarat has a maximum number of NRIs, what I heard over a period of time. So credit card spend has become very rampant nowadays. So when I'm using a credit card, I have to be careful whether I'm using my personal credit card or a corporate credit card. There is an internal guidelines which has come up, which my clients inform me, my banks, okay, when a corporate card is issued, it is specifically a declaration is given that this will be used only for the business purpose and not for the personal purpose. Earlier, what we as a professional used to do, okay, the company's credit card is spent by an individual who is going abroad for the work. After end of the day, he may be doing some shopping of his personal. He may issue a check from his personal account and give it back to the company, saying I am reimbursing whatever is spent personal. But that is not permissible anymore. Corporate card is only for the purpose of business. It cannot be mixed with the individual. Number one. Number two, buying a property by way of swiping the credit card is per se not permissible. Various calls are coming, a client sitting in the builder's office in Dubai and saying the scheme is getting completed today, I will have to swipe my card and otherwise the scheme will go. This is how they create the environment in the overseas country. And they say, even after saying no, the client will come and say, no, I have to done it. This is quite common. So what we need to keep in mind is inform the client that in the mode of payment buying the immovable property, money has to go from India, or if I open a bank account abroad under the LRS, that could be used to buy the property, but it cannot be used through swiping of the card. So with this background, can he make the payment using the company Forex card? So whether it is company Forex card or his individual card, Forex card cannot be used. That is number one. Number two, if the card is being used, the answer would be you will have to remit that money and bring that money back. But of course, that will be subject to compounding and all. If it goes unnoticed, clients have the audacity to say, એટલા બધા દેશમાં છે ક્યાં સરકાર કંઈ જોઈ લેવાની છે કે કોણ ક્રેડિટ કાર્ડથી યુઝ કર્યું, and rightly so, but it's all come when it come to the knowledge, information of the agencies. Tomorrow, the bankers will be the first people who will pass on the information to the Reserve Bank of India. The data are getting collated, the information is getting circulated between the various government departments of this country, and the time will come when all these cards spent, because the card which is spent outside India, TCS getting attracted, it will capture the information, and yes, there would be an implication. Now, what could be the implication? A, if it is done voluntary, the money has to be remitted outside India through the proper banking channel and bring back that money back to India, go for suo moto compounding. That is the only solution what could be. And if not done, tomorrow the Reserve Bank of India may come and say, please sell off the property and bring the money back to India. Is joint holding allowed when the joint holder has not remitted any fund? Yes. Now with the new latest LRS circular, master direction, point number 4, remittance under the scheme can be consolidated in respect of the family members subject to individual family member complying with the terms and condition. However, clubbing is not permitted by other family members for capital account transaction such as opening a bank account / investment. The property which was there earlier has been removed. So yes, even if property payment not being done, he or she could be a joint holder. Sir, your view on the same.
You see, the first thing is this credit card spend. See, in the good old days, when this credit card was introduced, it was a very restricted thing, and you can the online spend was not there. You can have to do it only at POS. And credit card used to be mostly used while you are traveling abroad. You cannot incur because online payment, etc. were not there. You could not do this sitting in India, incur on foreign expenditure, overseas expenditure. So that is the background. So if you do it outside India, it is then you had this FEMCAT rules, Schedule 3. Everything had a limit, and beyond that limit, you require you require RBI permission. One of them was travel abroad was $10,000 personal travel. Business travel was $25,000. Now, subsequently, this was amended, and it was what RBI said is that if you can, I'm introducing LRS scheme, you can do it for capital and current account. So if you want to go abroad and spend in excess of $10,000, you can do that up to your LRS limit, no problems. So that is how it came. Now the question is, as Rajesh Bhai said, you see there are people who spend on credit card LRS amount in a month's time. So if you include that, then what will happen? But then again, the problem is what RBI thinks from time to time is that if you allow that, then a lot of money is going out. You see, this through indirectly, through credit card spends. So they have been thinking of how exactly to control this, but the problem is difficulty. How exactly do you monitor credit card spend? That is the difficulty. But in principle, RBI will be happy to put some kind of a restriction on this. Only the mechanism is missing. This is number one. So when you are doing credit card spend, technically it is permitted now, as you said, but be a little careful. Particularly when you are in doing capital account expenditure. You see, a rich man, let us say he goes abroad, clubs 4 of the family members' LRS limit, 1 million he spends in one evening party. So that is all right. Technically it is all right. There is not a problem. Although it may optically bad, but technically it is all right. But if you are sending money from abroad for a capital account transaction where there is no limit, then you have to be careful because this can be held against you. The second thing is the use of the corporate credit card. Corporate credit card is supposed to be a business expenditure. Now in business expenditure, it is not related to a person. If my employer sends me somewhere, then it is the corporate expenditure. There is no limit on that. Okay? If I individually do it, my LRS limit will come into play. But I can very well go abroad for a month and be paid $1 million to spend there for whatever purpose. So that is all right. That is not subject to LRS limit. Corporate spend on corporate credit card is not subject to LRS limits because it's a business expenditure. But if you use it for personal expenditure, then that is a problem. And that too for a capital account. You buy a property, pay token amount, buy investment, incorporate a company, so that is a problem. So if somebody asks before that, then I would always advise that you don't do this. Make payment through the banking channel. As far as joint holding is concerned, it is perfectly all right. I mean, you can contribute, if you are contributing, if more than one person is contributing to acquisition of any property, there should be pro rata ownership. Now RBI has given some relaxation which is subject to dispute. But RBI has given some relaxation that if one person buys and other contribute the money, then it is not necessary for the property to be in the name of two persons. But this is, don't go by that. I would always still advise that have proportionate ownership. But if somebody is having ownership without paying it directly or indirectly, explicit or hidden, then there is no problem with that.
No, I'm sorry. I'll just add, one point which, with regard to this, is, with joint holding, one must also be very clear that data is flowing into India almost on a real-time basis, and data is coming to the Financial Intelligence Unit, from where it is presently definitely going to the tax officers. The other issue is that please be careful about which jurisdiction the client is investing into, where the joint holding is only in name, which is very frequently done as a practice in India. It is not appreciated in other jurisdictions. In one of our own cases, the concern was that in that jurisdiction, they clearly say that if you are not mentioned in the agreement, we will assume it to be 50-50. Now, 50% ownership declaration comes from that jurisdiction to the tax officer in India, who says that, okay, I can see that you are not remitted 1 rupee also towards this 50% ownership. Therefore, we will assume that it is Hawala. So please be careful about how it is structured in that jurisdiction. Succession planning to do through an agreement is possible in India, may not be easily possible in those jurisdictions. If necessary, you may have to get through a proper drafted will, which is correctly done as per the laws of that jurisdiction. So having said that, joint holding otherwise is allowed, but there are other repercussions and other implications which one must keep in note. And more importantly, capital account transaction of immobile property is one, but we frequently see people using corporate forex cards for incorporating companies abroad. Please tell your clients that is not done. It is all capital account transactions have to go through the banking channel. If they don't go through it, then to resolve it after a few years when the business has already started and gone through a full flow, it becomes quite difficult to administer. So, sorry, that was only 2 comments.
Just to add one more thing.
Yeah, they do compound it, but it's a painful thing. You never know what will be considered to be the, first of all, will there be an undue gain considered out of that violation? That, generally speaking, should not be the case. But we do have some examples given in the compounding rules itself, where they have considered a reverse transaction of an NRI buying a property which it was not allowed to. They have considered the full benefit or the full price appreciation as undue gain and taken it out as per their example of the compounding rules. And they have done that also. So my point is that be careful, because at that time they can go into, okay, fine, give us the financials, what are they, how much profits have you made, do you want to go into that? You don't. This was something which was anyways allowed. You could have easily gone through the banking channel. It should ideally be considered in that same manner, that yes, please, we want to regularize it, consider it. Earlier in the past it has happened in some cases, one of our cases, so a client had come to us having said that he has remitted much more than LRS limit. Those times the banks were not so vigilant. And then we had to write to RBI and say that, he is willing to say that, okay, for whatever limits he has exceeded, he will not utilize them in the future. And RBI did allow it, but with the compounding. But the problem here is that that may not happen today. And that's where the concern is that today, within a couple of months, the full data is here. It is only that sometimes the tax officer passes it to the RBI and sometimes it does not. But that does not mean that tomorrow it will not happen. So one has to be careful. Sorry, Rajesh bhai, yeah.
See, this is one area which again, I said I always gain from these interactions. This question, I have thought of it earlier, but then this should be addressed by RBI. You see, RBI has already, in the new ODI regulations, it has already taken care of the 6(4) money. That is, if a resident has any money abroad which he earned when he was a non-resident, or he has inherited from a non-resident, etc. So he can make a overseas direct investment. I mean, he can incorporate a company. There is no problem in that. But the same thing should be also applicable to if a resident has sent out any money and holding any balances legitimately, that is under LRS, then using that money, he should be allowed to do this. This is one thing I will take up with RBI. I will tell my friends that you do this. But as Rutik said, this is in essence all right, because already my money is there. I have legitimately sent it out. Why can't it be used for one purpose, some other purpose? Legitimately all right, but as the law stands today, don't do that, right? Yes.
Just adding to what the sir said, we have 2 live cases. A, the card payment was made in a very small amount, and then the whole remittance went through the banking channel. We went suo motu to Reserve Bank of India, and they have compounded the matter because the administrative procedure was completed where that first initial $50,000 we have brought in back before going for the compounding. And in second case, since the property was purchased from a third party and we could not do this transaction reversal, there in that case, the Reserve Bank has said you will have to undo the transaction of selling the property. So these were the 2 examples what I could connect with. The gain they had not referred to. They just said you bring the money back and they levied an amount of compounding fees on the same. Now, because this whole transaction was done in a span of 1 year and the transaction at which we sold off was almost akin to the money at what we was purchased. So there was no much gain in the same. Just to bring to the attention of the people who are attending here, this mix using of the corporate card with the personal, not even the abroad, even it for the local is prohibited, and it was mentioned in Economic Times on 12 June of 2025. and the use of credit card for purchase of property is strictly prohibited was highlighted to all the people by the same Economic Times on 4th August 25 and 23rd of March of 2026. So there is a continuous awareness through the media, but the people who wants to do will be doing the same, and this is how the professional will continue to practice. Thank you.
Yes, I mean a broad principle is never ever use a credit card for a capital account transaction. Any acquisition of asset, whether it is equity, whether it is immovable property, whether it is bonds, this should not be done.
Sir, just to share, now the new trend has started of buying the watches through the credit card. Watches.
Watches.
Which is again not permissible. But people are doing because it's a capital account transaction, sir.
Watches, no?
Watches.
No.
Permissible? Sure.
Yes.
Done.
Only question is, you see, watch is an asset or it is a consumption item. So that is a view that you have to take. This phone is a use item or it is a consumption item. If you are a company, are you going to capitalize it or are you going to expense it out? So that kind of a view is there. Watch is normally, if you buy a 5 million watch, then it can be an asset. But the one who buys a 5 million watch will perhaps use it as a consumption item. So the lines are a little thin. It will be subject to customs duty and other things, of course. But the question then will be that whether import is covered under that $250,000. So that is a question which RBI is not able to resolve. So they will have to resolve one day. That is, if I import anything, goods, this 250,000 is for those FEMCAT 3 things. Capital account plus FEMCAT 3 in excess of whatever restriction was there. Import of goods was not in FEMCAT 3. So if I am using, remittance from India for importing goods, it could be some medicine, it could be drugs, it could be some consumption item, whatever. From Amazon you can buy anything. Whether that is to be covered under LRS or not is the question. As on today, it should not be. But then this is one area where there is no clarity.
Okay. Yes.
Here I have not, the mic is distorted.
Rajesh bhai, you have said that purchase of a property from credit card, it is not allowed in out of country as well as in India.
The mic is not clear. We are not able to
Hear you.
So purchase of land, whether it is outside India or within India, it should not be done with the credit card transaction.
Purchase of land, purchase of immovable property outside India is governed by the FEMA. Within India, the FEMA regulation doesn't play at all.
Unless a non-resident wants to buy.
Unless a non-resident wants to buy in India. The question over here is a credit card or a forex card of a company used to purchase the property outside India. Within India is a different guidelines.
No, but you said practically speaking, for India as well, it should not be done via credit card.
No. I use the statement the corporate card should not be used for the personal purposes in India or outside India. Corporate card, as rightly said by sir, is only for the business of the company and cannot be used for the personal purpose.
But you see, that is something for your employer to decide, if it is within the country, whether they will treat it as irregular or not. But when it is cross-border, when you are using corporate credit card for a transaction outside India or sitting in India, transaction is outside India, then that is a problem. Because corporate card is to be used for business purpose only. Business expenditure is outside the ambit of personal expenditure. LRS does not apply. So if you use a corporate credit card for personal expenditure, even for current account transactions, then that is not in order. Capital account is absolutely no. Whether your personal credit card or a corporate credit card. No credit card should be used for a capital account transaction. Okay?
We move on to the next case study. The next case study is for Rutvik. The case study is very simple. I think Mondi sir has also dealt in some part on that. Indian resident has remitted funds outside India. The LRS was under LRS route. The use was, or the purpose was for opening a bank account outside India. Once the funds were remitted outside India, now he has decided to change the purpose and incorporate an overseas company. So whether change of purpose after remittance is allowed or not is the question.
Yes, generally yes. You see, only thing is, if you have remitted for a particular purpose, it must be a permitted purpose. Otherwise, remittance would not happen. If you are using it for some other purpose, that must also be a permitted purpose. Subject to this restriction, the change in purpose is all right. The revised change should also be permitted.
So just to add what Mohanty sir said, change of purpose as far as all permitted purposes are concerned, it should not be an issue. I think the query that has been put up is that if both are capital account transactions, whether capital or current account, ideally there should be no issue. But what has happened is in the past is that yes, there have been instances where people have sent funds for, let us say, education purpose, and then having sent there, they have utilized it for purchase of immobile property. RBI has compounded this. Now, there were some other elements also attached to that facts of those case. There was some Hawala transaction also, and ED had caught them, and somehow RBI still compounded it, but they have told that they are compounding it because of change of purpose. That has happened in the past. At the same time, we have had live cases where persons who have incorporated companies outside India but sent funds for that purpose by saying that they are opening a bank account, and that opening a bank account, they have later on incorporated a company. We reached out to RBI, and RBI said that no problem, you can file the form FC by changing the purpose code and then giving the details to the bank so that the UIN is generated. Because see, when you are doing an incorporation of a company or sending financial commitment, you need to do other compliances also. Opening a bank account, you may not need to do any compliance, but here you will need to do a compliance in the sense of filing form FC. That you need to specifically tell the bank that please write to RBI, my funds are already lying abroad, sent correctly under LRS. I want to utilize it for this purpose, and therefore funds which are lying abroad may please be considered towards incorporation of a company by changing the purpose code and then considering them for the UIN generation. Problem is that while RBI had told us, yes, this is all right, we have it in writing from them, banks are not listening to that. Now we are not only trying to say getting a clearance from RBI, first and foremost we have to get in all these kind of cases clearance from the AD bank. And AD bank is where the things get, kind of convoluted, because they themselves become authorities. And they say that no, they know what is our FEMA, and therefore they will be able to guide us better, when the person who is telling us that has only moved into the FEMA department 6 months back. Unfortunately, that is the reality of the situation. You have to keep pushing them to say that no, please send it to RBI first, and then let them say what they want to say, and then accordingly do the transaction. But sum and substance, this is possible. But if that happens, you need to get the bank on your side and tell them to write to RBI and get it done correctly. But as I mentioned, there have been one-off cases where they have compounded this kind of change of purpose code. I believe that was because of some other extenuating circumstances. As such, in general, as Mohanty sir said, why should there be any issue? As long as they are within permitted purposes, there may not be an issue at all.
So taking this opportunity, the master direction on LRS point number 10 says, individuals can also open and maintain and hold foreign currency account with a bank outside India for making remittances under the scheme without prior approval of RBI. The foreign currency account may be used for putting through all transaction connected with or arising from remittance eligible under the scheme. So under LRS, I was allowed to remit outside India, invest into the shares. 2013 they came up about this ODI, this whole 2000 notification 263 which came in, which said ki now FC form, this was only for the purpose of capturing. The interpretation by the bank, earlier sir we had one Reserve Bank of India, now we have 50 authorized dealers. So to get things through their legal team, compliance team, which is shadow, it's a more Herculean task. So what Rutvik bhai said ki by changing the purpose code and all, it's fine. But we have 3 live cases, sir, where the money which was used from my overseas bank account to open an ODI, FC form filed, change A2 filed, RBI's authorized dealers legal team said nothing doing. You have to bring the money to India or send the fresh remittance from India, get that money captured in the FC form and return the money over there. Otherwise, it doesn't match with our compliance team. Sir, what is your view on this?
I have taken note of this. As I said, if the money had gone legitimately out of India and is also used for a legitimate purpose, this should be permitted. Now this purpose code and A2 form, please remember that these are partly statistical, used for compilation of balance of payments. So these are partly regulatory because you give a declaration that I will use it for the purpose for which I have taken it and so on. But if I have money abroad which is legitimate, so that should be used for other purposes. And what you have said is that over the years, RBI is delegating more and more work to authorized dealers. Now the export regulations have come, which will come into effect from October of this year. It is entirely left to the authorized dealers. In a way, it is good because there is no reason why for everything one should run to RBI. But as you said, there are about 100 authorized dealers today. So the interpretation will be different. And sometimes they are more loyal to the king than the king himself. So RBI's rule interpretation, they do more strictly than RBI. I do not know. Maybe sometimes when it suits them, they can do anything. But yes, this is very much a problem. So RBI is already engaged with FEDI that how exactly to evolve uniform practices. And anticipating this, in FEMA there is a provision. If you read section 10 of FEMA, it says that an authorized dealer can ask for all documents to put through a transaction. But if they refuse to carry it out, they have to refuse in writing so that RBI can take action against them. To go into why they have refused to carry out an action. So, but that somehow other, banking is always a relationship thing. So people do not want to change banks. People don't want to take the banks to task. So these problems continue. But yes, I have taken note of this, and this is something which, again, the question number 4 also deals with the similar issue. That is, you have sent 10,000 under USD 10,000 to your brokerage account to buy, to invest anywhere. You might have even sent $250,000 looking for a property. And within 6 months, you are not able to find any suitable investment. So what do you do? Can you retain the money? Now, whether there are some minimum balance requirement, so that much money, whether you can, the answer to these questions will be yes. That is, if you had sent an amount of money and you are not able to find investment opportunity, so this is something which is a little difficult to explain. Because investment opportunity is there everywhere. And you don't take 6 months to identify a stock or a mutual fund or in immovable property, this problem can arise. But then if you remit the entire 250,000 waiting for something to happen, then this is unlikely. You can send a small amount of money, token money as it was. So it will depend upon essence. But yes, you can certainly maintain a small amount that is required to be maintained either by the broker or the bank. It will not come within that 6 months restriction because it is to be maintained at all times. RBI is not going to raise any objection to this. Other money, if you have sent and you shortly exceed 6 months, then there is a problem, but then you will have to establish your intentions. This can happen. Suppose it overshoots by 10 days or 15 days. RBI is not going to prosecute you. Just like an exporter is supposed to realize the money within 9 months or 15 months, and suppose the money comes 1 month after 9 months, RBI does not take any action. Okay, so it depends upon the intention. But this point I have taken note of it, that if you have money, a resident individual has money abroad, which he has legitimately sent out of India, he should be able to use that money for any permitted purpose, including incorporating a company. This aspect I will, of course, take up. Okay. Number 4, if you have to add anything, otherwise we can go to
question. Yeah. We can go to question 5.
Sorry, to the question, the purpose of investment, can the temporary fixed deposit with bank considered to be investment in this purpose?
That is another gray area. You see, RBI's view predominantly is that you should not create an FD. FD is not seen as investment, which is hotly contested by a section of RBI and a lot of outsiders that it should be treated as investment. But as on now, my advice to people who pose me this question is, don't do an FD. Obviously, you are doing it outside India. There are much better avenues like money market mutual funds and things like that, which have liquidity, better return. And FD is not something which people do outside India. FD is something typical to India and undeveloped markets like this. So they have those negotiable orders of withdrawal account, which is better than a bank account. You can take out money anytime you want and it gives you a better return. So you do better one of those things. Have a mutual fund, money market mutual fund or something. Don't do a fixed deposit.
Thank you.
Sir, we went to CGM or the client who had very high profile post of this country, and they said, okay, sir, if you say, because there was again an Economic Times article which said that the FD is not considered as a proper form of investment and it has to be brought back within 180 days. So with that article, we went to Reserve Bank of India and said, okay, sir, if you feel that FD is not a proper form of investment, please come out with a FAQ and say, okay, sir, this is not permissible. Then the people at large will know what is the viewpoint of Reserve Bank of India. Because, sir, everybody wants to abide by the law of this country, but there has to be a clarification and clear-cut answer to the same. If you, as a government official or Reserve Bank official, say, it's a grey area, what stops government to say, this is white and this is black? Because otherwise, how the people will come to know? And let me tell you, sir, after 3 years, till Reserve Bank of India is not clear whether to treat it as an investment or to block it as an investment.
See, this is, it is all right. People don't find clarity. But then for Reserve Bank also to issue clarity is very difficult. It is not an easy thing. Unless you want to go back to the FERA regime. In FERA regime, for every single thing, for a single dollar, you have to run to RBI. You cannot buy your non-resident visitor a cup of coffee without RBI's permission. I remember in 1983, Institute of Chartered Accountants was holding its 50th anniversary or something like that in Calcutta. And incidentally, this PwC or Lovelock Lewis, one of them was sort of acting as host. Some, those days, some Lord something from Institute of Chartered Accountants of UK was the chief guest. Because those days we had, even today we may be having very strong tie with UK. And after all, this ICAI is a kind of offshoot of their institute. They had taken RBI's permission for paying for the hotel bill of Lord something and his lady. The Lord arrived with his daughter. And the institute, the Grand Hotel, those days there was only one 5-star hotel in Calcutta, that was Grand Hotel. They will not like the Lord to pay for his daughter's bills. And Grand Hotel will not take them in unless, they pay themselves. Making them sit in the foyer, they ran to RBI. That please give us permission, we are in a very embarrassing situation. So this is what it was. Unless you want to go back to that kind of a situation, that everything you come to me, I will decide, to tell what you can do, what you cannot do is a difficult thing for RBI. For instance, you look at this FD. For you, it is a simple thing. For us, rather, I am on the other side of the fence now. It is a simple thing. Tell me whether FD is permitted or not permitted. Now, RBI will see many things. Why has LRS been allowed at all? LRS was allowed because of portfolio diversification. That is, you remember Tarapur committee, they said that what is the way to capital account convertibility? First allow corporates, then allow individuals, then allow financial institutions. So corporates were almost free capital account, then individual are to be allowed. So they said, let us give something to the individuals. The initial thought was, I remember the CGM was Maheswaran at that point of time. He said, that this is I am giving you for good. It only in 2004 it was $25,000. For all I care, you can take these $25,000 and throw it to the sea. I don't care. So that was the attitude. But then subsequently it was increased. When you increase, then the things arise. Then why will anybody, instead of opening FD in India, the whole world is coming to, because interest rate is so high, why will anybody go and open an FD outside India? That is one thing. You are deprived. The other thing that RBI has to think of, you are taking out resources from the banking system of India. If I take out money and keep it with Wells Fargo in Newark, then I have deprived the State Bank of the funds. If they are deprived of the funds, then where will they generate savings? So there are a lot of thoughts which have to go to, and it is not very clear. And then they are thinking of permitting it. Then today kind of situation arises. So all thoughts go back to the, whatever liberalization thought. Now they are seriously thinking whether they should put a ban on gold ETF. Okay, thinking of this, because everyday paper, last year gold ETF got how many? 400,000. So much. So gold ETF have to buy gold. That is leading to import of gold. So they are thinking about that. So it is not a very easy thing for RBI to issue clarification unless they simply ban it. Like, I don't know how many of old timers you will remember, after the Pakistan war of 65, 22 karat gold was illegal. If you were found buying or selling 22 karat gold, you could be imprisoned. Unless you want that kind of regime to come back, it is very difficult. Anyway, please.
No, I'll only add, sir, that thanks to your experience, we are benefiting here. The only thing I was thinking when you were telling me is that if RBI is to get into all of these things, that itself shows its myopic view. Let us just put it into context. LRS scheme was introduced, they've increased it, and as sir also referred earlier, they may reconsider, it has happened in the past, they've reduced the limits. It is a policy matter, they can do it. And sometimes people come to, and we have had discussions, even with the present, RBI officials, and they say that no, so much of LRS is going out. How much is going out? $20 billion. Is it a big sum? They started this scheme when they only had 100 billion in reserves. Today they have more than $600 billion in reserves, and still RBI is worried about LRS. What can happen out of LRS? $20 billion, frankly, for RBI is neither here nor there. But the focus is there because it's a transaction which is impacting individuals who are able to send those funds. How many are able to send? Less than 1% of India's public can actually send those funds abroad. But even then, it becomes a hotly debated topic. I think somewhere, ideally speaking, there has to be some threshold limits into which RBI does not even bother to look at. But unfortunately, that's a high call, and I don't know when that will become true. But sir, many thanks for your comments. I think I'm so sorry, I just wanted to put in this point.
Basically, the issue is that, you see, at this point of time, there is a lot of move to be restrictive. The question is, there is a section which wants to bring back all kinds of controls. There is a section which says that it is not time consistent, that if you do that, for instance, tomorrow if you ban this, then people will not come here in the first place. Yes. So, whatever, that is why in 13 there was a measure to undo that 1 million thing. Yeah. So at that point of time, my view was that you don't do it, you have allowed how much money is going out. Why do you, so let's wait. So, but it is a difficult thing. My point is that yes, this can be done, that can be done, all right, perfectly all right, but it is a difficult call to take. Yeah. Yes.
Okay, we can move on to the next question. Yeah, question number 5 is for Rutvik. Yeah. It is related to inheritance of foreign securities and immovable property by son from their resident father. So, whether the LRS character continues, and can the son receive the rental and dividend income abroad and reinvest, and can he sell shares in the property and reinvest the same within 180 days? Rutvik, your views.
So friends, I think this query number 5, what it brings out is the amendment which had happened in August 2022 to the OI rules, where for once, what we have just now, a minute back we mentioned, but RBI has been liberal enough to make it very clear that there can be inheritance by a resident individual from another resident of immovable property acquired abroad or shares and securities acquired abroad. That is very, very clear. The reference has also been given in the query itself. And therefore, person who is a resident all his life can also inherit from another person who has also been resident in all his life in India. There is no 6-4 element coming into this. The funds which have been remitted under LRS scheme, and the properties and the securities have been purchased. So very clearly inheritance is allowed. There is no fallout over there. The problem lies with the issue about what to do of the incomes which are received on such investments or property by the resident heir. That is where the concern lies, is that, okay, what has been allowed under LRS scheme? If you look at para 17 of the LRS master direction, it says that investor who has remitted funds under LRS can reinvest the income earned on the investments, is what has been stated as the first line of para 17 of the LRS master direction. Unfortunately, there it talks about investor who has remitted funds under LRS. It does not talk about investor including the investor's heir. That is where the problem lies, that when the heir gets the property or the investment, can he retain it? Can he retain those incomes earned on it abroad? We have to juxtapose it with the fact that, yes, if there is any income which is earned by any resident, let's say any of us sitting here, any income earned abroad, we have to summarily get it back into India. That is the law of the land. LRS scheme made an exception to it and said that, yes, you can retain incomes abroad. That exception has been limited only to the investor as per the master direction. There was another additional line which was unfortunately removed in 2022 amendments which happened in the LRS also. That line read, I am reading it from the FEMA manual itself. On August 24, 2022, it had tried to align the LRS master direction to the directions with regulation 7 of FEMA 9R. And it says that prior to that modification, it said that at present, the resident individual is not required to repatriate the funds or income generated out of investments made under the scheme. There it did not talk about the person who has remitted, it just talked about resident individual who has investments lying outside under this scheme. Unfortunately, that line was deleted in this whole, rigmarole of trying to bring LRS scheme. See, 2004 when LRS scheme came, and what sir also mentioned, it has been mentioned by Dr. Y.V. Reddy in his book also, where, Jaswant Singh ji was the finance minister, and they said that let's make one small step towards capital account convertibility, $25,000, go ahead and do what you want. That scheme was born out of FEMA CAT rules, and it served to give several exceptions or exemptions from what was otherwise allowed under the FEMA or what was actually not allowed under FEMA. Over time, RBI's thinking has been, in what we have understood, is that it has to be encapsulated into some other notification of FEMA. It cannot be a scheme of its own. In doing so, August 24, 2022, they brought in that it has to be aligned with FEMA 9R, as if that was always the case. That was not the case. There was a clear exception. But today now they want to bring it under, and therefore they are kind of saying anything which is allowed under LRS, if it does not find a mention in the relevant notification, then it may probably be in the gray area. That is where all this FD and all those issues also come out. But the problem today that we are dealing with, whether he can retain those incomes abroad or not, the LRS character gets lost when the resident heir inherits it. Is it practical? No, definitely not. It is very impractical. We have had conversations with earlier CGMs, and they have told that who is stopping you from coming to us. If there is a genuine reason, then we may allow you to hold those or retain those incomes also abroad. But that means, as we just now discussed, going to RBI again and again. There are today several such cases of LRS investments which would obviously be inherited by a person resident in India. Under policy level, it should definitely be allowed, but the language of the law is not there to support it. If so, then it's better to seek an RBI clarification and then retain those incomes abroad. I hope I have answered the query fully. Yeah.
Monty sir or
Yes, see, I'll draw your attention to two things. First thing is that as far as current account is concerned, under Section 5 of the Act, everything is permitted unless prohibited. In case of capital account, everything is prohibited unless specifically permitted. That is, that always keep in mind. So, in any capital account transaction on wherever, under LRS, otherwise, if it is not specifically mentioned somewhere, then it is prohibited. That is one thing that we have to keep in mind. Second thing is that about this inheritance of asset from a resident. You see, a resident has some assets outside India. these assets could be the assets that this person had earned and created when he was a non-resident, or it could be that the person has created by remitting money legitimately from India. The law is not clear about inheritance of these assets from a resident. I'll read you out what the law reads. Section 6(4). It says a person resident in India may hold, own, transfer or invest in foreign currency, foreign security, etc., if such currency, security, property was acquired, held or owned by such person when he was resident outside India, that is, he had earned it, or inherited from a person who was resident outside India. Underline this. Inherited from a person who was resident outside India. This was resident outside India when? At the time of inheritance or at the time of creation of the asset? This is not clear. So this is a gray area. So if such situation arises, then whatever view that we take must be a qualified view. If I have LRS property, my son, whether he can inherit it or not, inherit, of course, you can't stop inheritance, he will inherit, but whether he can continue to hold, own it, or you have to bring it back to India, so that is not a settled question. Similarly, what is also not settled is, I have 6(4) wealth, but I have come back to India. Now my son inherits it. That is, at the time of inheritance, the testator was a resident. So if you have inherited, had I been non-resident and then my son inherits it, then of course he can hold on, etc., everything. But if I have become a resident, then whether he can hold it or he will be required to bring back is a gray area because of the wordings here. So that we will have to keep in view in dealing with these matters.
Yeah. Sir, I think here the case study, which we are dealing with was talking about two resident individuals only. The father and son both are resident only. So there is no 6(4) case here.
No. Father created the asset
Out of LRS.
Out of LRS.
Yes.
Whether the son can inherit this.
Yes.
Son, of course, can inherit it.
Right.
Can he retain it?
That is the issue. So that
That is the issue.
Yeah, you're right, sir. So 6(4).
So that retain, no. 6(4), when 6(4) is not clear, you cannot give clarity to anything else.
Okay, understood. Right.
So if 6(4) is not clear, if I have 6(4) wealth outside India, I am a resident.
I understand.
Now my son gets it.
Yes.
So if he cannot retain that,
Agreed.
then anything else will be inferior to that.
No issues, understood.
But sir, just taking to Rule 21 of the OI, it says a person resident in India may acquire, so let's say a son, may acquire immovable property outside India by way of inheritance from a person resident in India, father, who has acquired such property as per the foreign exchange provision in force at the time of such acquisition, which is LRS.
See, you can always inherit. The question is whether you can hold. You see, it cannot be intention of any act. You see, any act cannot be against public property. If my property, whatever I have, if my son does not inherit, then the government of India will get it, or who will get it? So it has to go to my son. The question is whether my son will be able to hold it or will have to dispose it up and bring back the money.
So for an immovable property, sir, we have got a clarification from Reserve Bank of India that till you are holding the property, till you are not disposing of the property,
Yes.
you can retain it.
That view we have taken under that amnesty scheme also.
Okay.
That because you see, immovable property selling is something which is, we want to be, because it is not liquid, first thing, it is not liquid. Second thing is that you may need it for whatever purpose, something or other. So immovable property we take a little, RBI takes a little liberal view that if you have acquired it, then you may continue to hold it for at least for some time.
Because sir, there were three categories: immovable property, shares of a foreign company, and the bank balance. So Reserve Bank of India said that bank balance you bring it to India, the foreign securities and immovable property you can continue to hold. So whether it was a specific approval
No,
given,
here again, you see, if you have created an asset, it is a pragmatic view which is taken. There has nothing been, you see, why the pragmatic view is because share and security, for instance. Let us say I have some assets abroad which are direct investment. It's an ongoing company, a going concern. So RBI, it will not be very unfair for them that you sell off the going concern and bring it back. Okay, so therefore securities they permit. Immovable property for the same reason they permit. If you have idle cash, then you bring back. That kind of it is a pragmatic resolution rather than anything in the law, strongly built in the law. ODI investment by an individual, and then.
Sorry, just to clarify the facts,
Yeah.
your point is that the mother has invested from India,
Yes.
a resident individual who has complied with the FEMA provisions and they made an ODI investment, right?
Yes.
So-
It's in, technically it was LRS because.
Correct. But any investment in an unlisted company comes under ODI, so
Correct.
what we consider it as LRS
ODI, you make the
Correct.
yeah. And then her son, being then an NRI, over a period of time turned citizen of US.
Right.
Now the funds are there, the profits are parked there. She
Correct,
doesn't want to
correct.
bring it here because of the age and whatever purposes. So now she has been decided to gift everything to her son
Correct,
via
correct.
foundation in UAE.
No. So just on this specific fact, so see, first of all, let us be very clear that any funds which are sent abroad under the ODI rules, okay, because these are clearly ODI rules applicable. The limit is LRS, that you as an individual can remit abroad. There are certain conditions also attached to it. Any investment made under ODI rules, the reserves which are built up there can be utilized as much as you want for the purpose of the business, or then they have to be remitted back to India as dividends. They can never be transferred abroad to anybody else, because then that's a clear violation of FEMA.
No, but then the ownership is transferred to her son.
No, I think the reserves are being transferred or the shares of itself are being transferred.
The shares itself are transferred to son.
Okay. But shares being transferred.
Shares have been gifted to the foundation in UAE.
No, I understand. I don't think so it will be allowed, because I don't think, Rajesh bhai, if you feel anywhere.
I'm not
Any
able to
particular
hear you
clause
clearly,
under
but
which.
if I get from the an individual has made investment outside India
Yes.
under LRS.
Yes.
This is in an unlisted company and therefore it is treated as overseas direct investment.
Correct.
Now, what all he is supposed to do? This is perfectly all right. You have to report it, obtain UIN, etc. Compliances will have to be done. Then this company will be run as a business. Shares you are owning. Any transfer of shares will have to be for value
Correct.
and at fair value.
Absolutely.
Okay. Or it can be, transfer can be through any corporate process, that is merger, acquisition, etc. But then if you transfer the shares, you have to receive value for it, in
Correct.
cash or in kind. You cannot transfer otherwise.
It's
Now,
a gift, a
whatever
donation
profit it
to.
makes, let me complete then.
Yeah.
Whatever profit that company makes, that profit it can retain, transfer to its balance sheet from profit to create reserves, or you can distribute as dividend. And reserves you can use in any way. You cannot give, that corporate cannot give any money or anything, any resources to any third person.
So what I'm trying to say is the shareholding of US company has been gifted to her own foundation. Of course the transfer is made. The transfer is made at free of cost because it's a donation which is given to her own family discretionary trust.
No, you were saying that the shares of this company will be contributed to a foundation.
Right.
No, that is not permitted. Nowhere.
Sir, these are the structures done by the advisors of the Dubai so-called foundation. Okay, this lady who has created this wealth in US through the Delaware company, now son is a non-resident. Prior to August 2022 circular, this was permissible. After August 2022, sir, an Indian lady holding the shares of a US company could be gifted to a NRI, which was permissible earlier. But now, if you go to master directions on this overseas investment, point number 22, subclause 4, resident individuals are not permitted to transfer any overseas investment, which are the shares, by way of gift to a person resident outside India. So this foundation is nothing but a person resident outside India. Now it is specifically prohibited that those shares cannot be gifted. As sir rightly said, You create a fair value and transfer it is permissible, but not gifting anymore. The law was different prior to August 22.
August 22 also it was not clear.
Earlier, the LRS master direction said that the shares which was purchased by way of LRS could be gifted to a relative outside India, which now they have specifically prohibited.
Relative, yes. You see, the earlier provision was in that you can receive any gift from non-resident, but I always used to say that don't do that.
Okay.
Because the problem is that you will fall foul of FCRA. You
Now
receive
the
as a
FCRA
gift.
is brought
Now
in.
they have linked it to FCRA. That okay, you give gift or receive gift only as permitted in FCRA.
Sir, can you go back and refer to the clause and circular just for my reference? The one you mentioned, 22 subclause 4 of?
Master direction on overseas investment. Go to point number 22, which says overseas investment by resident individual. So this lady was an Indian resident who invested under the ODI scheme.
Correct.
Post August 22, point number 4 specifically says resident individuals are not permitted to transfer any overseas investment by way of gift to a person resident outside India.
Okay.
Clear?
Thank you.
Thank you.
We can move on to the next case study now.
Next is 6.
Final conclusion for?
Question. So the final conclusion is that yes, LRS character of the investments abroad do not pass on inheritance, but you should ideally apply to RBI for a clarification, and if they allow it, then it can be held abroad. The retained incomes can be retained abroad. Otherwise, presently, there is no clarification provided on what happens to those incomes abroad. What was earlier available in the master direction has been removed. So that is where it stands today.
Sir, if
1 minute. Before going to the next, since he raised issue, sir, under the Indian Succession Act, the person who bequeath the property to a next generation, the legal heir, he comes into the shoes of the same as a person who is making the will. So can we take the stand that this son who has got these shares will fall into the same category as an LRS investment which was validly done by his father during the lifetime? Because the shares which will be holding.
Again, I just remind you, inheritance is not prohibited. Anybody inheritance is not prohibited. The question is, what do you do with that? Can you hold it? Shall you have to dispose it? Whether you have to bring back the money or take out the money? Some time back, I had a case where a rich lady died, and in her will, all the property was willed to some saint in Africa. Okay, and it was property running into several tens of millions of property. So whether that saint who was inherited this property, can he take it back? Can he take it out of India? So that is the question. You inherit it, okay, all right, you take that money, you set up a math or ashram in India, that is all right. But whether you can take it to Africa, that is where the problem comes. Inheritance is not a problem.
Sir, in the same question, I would like to make it a little bit complicated. So, whatever we discussed till that, like so. Okay. So, in the similar case, we have discussed the erstwhile cases as well. So, there is one fellow who has made a partial payment, 100,000 euros, for a purchase of a residential house, and then he has went.
You are going back to the earlier question.
Yeah, but it is linked to over here.
Okay.
Okay, I'm coming to here only. So in that question, they have a deferred payment plan, and they have invested in 2024. Okay, in 2025 December, that fellow died. He has paid only 5% of the value, but during the last 2 years, the property price has shoot up by 2x. Now, the inherited person has received this property, but looking to the FEMA provision, like he has made a payment through a forex card or credit card, a partial 5% of that value, and the property value of 100,000 euros become 300,000, and he has made payment only of 10% of 100,000. So, what are the views on this?
So as Rutvik Bhai had said, gain, undue gain, which has come. My example, what I gave of compounding was the value did not change much. Here the value has become 2x and 3x. So best way is to go to Reserve Bank of India, dispose of the property, go for compounding and close the matter. So there is one more case study ke who can apply for compounding. So it is the applicant who has done the contravention, and even the legal heir for the same contravention can apply for compounding.
We move on. Now I think, can we skip case study 6, because I think it is related to trust, which was discussed in detail yesterday, correct? So,
नहीं रश्मिन भाई ने view दे दिया.
because I think in the interest of time. So we can go to case study 7, which is remittances from India. Case study 7 is for Monty sir. That Mr. Akshar is an NRI. He has invested in several businesses through partnerships and LLPs, and this investment was made when he was a resident. Subsequently, this Mr. Akshar, 7. Case study 7, sir. And subsequently, he became non-resident. So he is using his $1 million route to take out the funds from India. Now, some 3 options has been suggested, whether he can use it or not, for transferring funds over and above the $1 million limit. That is the main question here.
See, basically the issue is like this. There is a NRI who has a lot of investments in India, partnerships, LLPs, etc. Mainly through partnerships and LLPs. Now the question is that what all he can take out of India. First alternative is family trust. This RBI's principle which RBI has enunciated is this. Rasmin Bhai is an expert on trusts. We have had many long discussions on trusts. So he yesterday would have covered this whole thing. RBI's stand is this. You cannot do through trust which you otherwise cannot do. A trust, by setting up a trust, again, like inheritance, nobody can prevent you from setting up a trust. I have property, I am alienating simply for the benefit of somebody and giving responsibility to my designated trustee that you look after my property, whatever comes out of it, you give it to the benefit of this. So nobody can prevent me from setting up a trust. The question is that the beneficiary cannot derive any benefit more than what is otherwise legally permitted. So this is a thing which RBI has enunciated, and this is how we have to evaluate it. So don't think that by setting up a family trust, you will be able to remit anything more than otherwise provided. So now what is the otherwise provided? Now, whatever business interests you have in India, when you become a non-resident, 6(5) permits you to hold on to everything, no problems. Any income that you get out of it is perfectly repatriable because it's a current account transaction, no restriction. Any dividend, profit, interest, etc., everything is repatriable. The question then comes in the sting is in the tail. It's a partnership or LLP. You sell some assets because if you sell some asset, that becomes a capital account transaction. Asset was capital account, so sell proceeds are also capital account. But you can use the accounting camouflage that a partnership has liquidated assets and distributing it as partners' income. So that may be accounting income all right, taxation income all right, but that will not become FEMA income. So that is not repatriable. Clear? Any comments?
Second point. NR to NR transaction.
No. See, that is not permitted. Again, principle is, if the NR is holding any assets on non-repatriable basis, he can sell it to anybody. But the sale proceeds, he can sell it to an NR who will be holding it on non-repatriable basis. No problems. If, let us say, tomorrow the promoter of a pharmaceutical company becomes an NRI and sells that company to Eli Lilly or some other pharmaceutical company, no problems. But the money that he receives will have to come to his NRO account. If it is non-repatriable, this is the essence. Because otherwise, what is the meaning of non-repatriable? I simply become a non-resident, like that student. For 1 year, I go and set up residence somewhere, and then sell my asset and take out all the thousands of crores of asset that I have. So non-repatriability will not mean anything. So therefore, if you are holding any asset on non-repatriable basis, the sale proceeds of it has to come to your NRO account.
Just to add over here, we, of course, forming a trust doesn't increase the limit or anything, but Reserve Bank of India is such a genuine organization where in one of our case, we went to Reserve Bank of India and said, this is an old lady, now she is settling back with her son in Canada, and property sold is of 100 crore after payment of capital gain tax. In those time it was 23%. What will this lady do in India when there is nobody over here? You won't believe, friends, without visiting Reserve Bank of India, we made an application through the authorized dealer where that balance 77 crore was lying. In 7 working days, we got the approval. Yes, you can remit everything subject to a CA certificate that there is no further tax on the same and the taxes has been paid. Second case of a shares which was inherited, because today gifting of shares beyond 5% and a $50,000 is also with the prior approval of Reserve Bank of India, so you cannot give. So this is a major area of concern where the next generation is all settling abroad, and the Indian patria who are based in India cannot give those shares to the next generation because the limit is 5%, $50,000 and all. And so when those shares are being sold or there's been being gifted by way of inheritance, the next generation wants to take it back because there is no presence or anybody over here. Go to Reserve Bank of India and give a genuine reason why you want to remit it outside India. They will give the specific approval to remit outside India. But under the general permission, 1 million is the limit. And for the current income, what they define is the dividend, interest, rent is all fall under the current income. The capital gain and the sale of asset will not fall under the current income. Even a partnership firm share of profit is a current income, but if the core activity of the partnership firm or LLP is on those shared securities and the capital properties, then it will not be permissible under the current income. Yes, thank you.
You see, but there is a provision, this FEMA 13, that is repatriation of assets. Any non-resident or even a foreign citizen who comes to own assets in India can always apply for repatriation.
Correct.
And what view RBI will take will depend upon those times. This permission that you got must have been in 2006-7.
No,
that
sir, 2022.
2022. Yes. I mean, normally you see, there are many cases. In Bombay, for instance, a lot of these Portuguese ladies, they inherit property from Indian guys. You see, somebody might have gone to Portugal and become all these Goanese Christians and
Correct.
from Daman and all other places. So RBI does permit. It is not that RBI does not permit.
Sir, one question. So let's say one non-resident Indian invested in one Indian listed company when he was NRI. Now he came to India, became a resident. Can he contribute those shares in his Indian family trust?
Can you continue his shares in?
Indian family.
So he wants to transfer those shares to Indian family trust? That's what you are saying?
Yes.
NRI, when he invested and was under the repatriable or a non-repatriable?
Non-repatriable.
Non-repatriable. Then there is no problem.
And in case it is repatriable mode?
He wants to transfer the shares into an Indian family trust.
He is an Indian resident.
Indian
now.
resident.
FEMA only does not.
Even if it was under repatriable condition, you can
Correct.
always transfer it to a trust. As I said, you cannot, there is nothing to prohibit you from creating a trust, transferring your asset to a trust. There is no law which will prohibit that. But the question is that what do you do after that?
And sir, more important will be who are the beneficiaries of the
Who are
trust
the
will make all the
beneficiaries?
differences.
If it is non-repatriable shares and you make non-residents the beneficiary, then there will be a problem that what can be taken. So, I mean, it cannot be more than what you could have taken. Okay, so those kinds of considerations will have to come. Always remember the principle, whatever you could have done legitimately before setting up the trust, you cannot achieve anything more than that through the trust.
Understood, sir. Thank you.
Okay, so now I think we are on case study 8. We are running behind time. So now we have two options. Either we take through all case studies quickly, or we take few of the selected case studies in detail so that each one of us has a better clarity. We can skip it, no? Some of the case studies. Okay.
Safe note, I think is.
Yeah, so we can go to case study 9 now. It is related to safe investment in safe.
Safe as it stands is not safe at all. This was the word of the RBI official. These are all the commercial jargons which are used. Simple agreement for future equity, where all these celebrities, the athletes, the cricketers, they make investment and they get a barter safe in lieu of their promotions or the performance and over here. So, prima facie, the question is whether the investment in safe note an equity investment or a debt. It's always a debt, it's not an equity. Equity will happen over a period of time. So today, is it permissible? The answer is no. But we have seen many a times that there are barter deals happening whereby the artist will perform on behalf of a foreign company and do some endorsement on the social media marketing or whatever we call it, and they will be issued safe. We have taken a view, no, this is not permissible because this is not an equity. So capitalization of export cannot be in the form of safe. It has to be in the form of equity only. And 2, we have come across cases where people have remitted the money under LRS to acquire the safe. And the bankers per se have said, you just mention as an investment, don't mention in equity shares or in safe. And the money has gone. One client said, sir, आपने तो ना बोला था, ये देखो banker ने तो कर दिया. So we said, sir, please give me the A2 form that they have said investment only and not specifically safe. And as Bonti sir rightly said, in a capital account transaction, whatever is mentioned is only allowed, whatever is not mentioned is prohibited. Current account transaction is other way around. So, investment in safe per se is prohibited because it's a debt, and you can invest, you can make a debt investment only if you are holding equity in that company. So, per se prohibited. Yes, sir.
See, you know that for inward investment, safe kind of investments are permitted.
Yes.
For inward. So that is, I had during my time, it is called convertible notes. So basically it is, the transaction is like this, I give a loan, I give you money, unsecured money, and you promise that you will at some point of time, you will give me equity at whatever value. So the startups made a request to us that you please permit this, so we permitted that. But before permitting that, it had to be enabled under companies' acceptance of deposit regulations, Companies Act regulation, because these will be treated as deposits. So when you are investing in SAFE, what are you doing? You are investing in unsecured debt of an unlisted company. Where is FEMA? Where does FEMA permit? FEMA permits equity, FEMA permits, if you invest in listed equities, it is portfolio investment. If you invest in unlisted equities, then it is FDI. And if you invest in listed debt, it is again under LRS or portfolio investment. But where is the permission for investing in unlisted, unsecured debt? This permission is not there. So you cannot do that, whether you are individual or a corporate.
Just one note out of recent experiences, some safe agreements are coming in a manner of having those instruments as mandatorily convertible. In those kind of instances where the definition, it may fall within the definition of fully and compulsorily convertible instruments, there could be a way to say that yes, safe investment is possible, but those are rare instances. Otherwise, what Rajesh Bhai and Mohanty sir have mentioned, that is the rule of the day, that yes, most of the safe agreements are not possible to be done because there is no leeway out. However, there have been some recent instances, probably at the behest of, advisors that, this agreement cannot work. They would kind of tweak, because when money has to come, people will tweak their agreements. And they have mentioned that, yes, if at all, then we will definitely issue equity instruments against this particular investment right now. But that's, as I mentioned, is not often the case.
Okay, moving forward, next case study.
10. Which one?
Case study 10 number.
10, sir.
Case study 10, swap of
9,
shares.
9, 10. You see, 10 is a very simple question. That relates to swap of shares. Swap of shares where there is overseas investment. In any case, in the current regulatory framework, transfer of shares should be for value, whether it is in cash or in kind. Either you should rotate cash or you can do a swap. Swap has to be for value, that you have to, the swap ratio has to be worked out according to fair valuation. So you can very well do this. Here the issue is very simple. There is an India company. Below that there are two parallel structures. One is in USA, one is in Singapore. Now it wants from here to go to a situation where India will own USA and USA will own Singapore. So this is very simple, it's not a very complicated transaction. So basically what will happen is the Singapore share India company will transfer to US and US company will issue its own shares to India. So this is perfectly permitted, no problems. Any swap always think that the value is preserved. The regulations say that all transfers should be for value, in cash or in kind.
Sorry, I think just to add, this query probably has come from the issue of, tomorrow the India Co. in this particular structure, if you note the post-swap position, it shows the India Co. will hold the US Co. under which there will be a Singapore Co. This can happen only if India Co. technically says that there is a transfer of its ODI investment in Singapore Co. The problem that I think earlier issue was that the language does not on transfer cover swap as a mode of transfer. This we had also raised with RBI managers in our conference which happens in Bombay annually, and they had clarified that yes, the intent is that the swap should go through. If the wordings may not be there, they at that time said that there would be some, their clarity was that it is still allowed, transfer by way of swap is allowed, otherwise the whole scheme would fail. So that clarity has also been given by them. But that's a, nuanced issue of transfer, not including transfer by way of swap as far as OI rules are concerned.
Perfect. Okay. Moving on, next case study number 11, treasury management by foreign entity.
Yeah. So here again the query is simple. You have made an investment, an Indian company has made an ODI investment into a foreign entity, and there are reserves which are lying in the foreign entity. This query comes often to us saying that now the foreign entity does not require it for its business purposes. So why not it, tomorrow invest into say mutual fund units, money market investments and any other category. In fact, one client actually went ahead and bought a property and started leasing it. So now these kind of queries do come. The problem is that when you are making an ODI investment, you are making it for a particular business purpose. That is what has already been put across in the form FC. And in fact, in some cases, you have to put in the NIC code also of what is the overseas business which is done. In which cases, then you also have to say that, yes, that is the business of the foreign entity. Now, let us say that you incorporated the company for doing some regular operating business. It's not mentioned here. Let us say, for example, it is pharma business. Now, once you have stated in your form FC that the investment is made for a pharma business, the foreign entity is supposed to be doing the pharma business. Let us say that those reserves are accumulated and then invested into the stock market or mutual funds. That was not the purpose for which the ODI investment was allowed. Apart from that, the problem is that if there is an overseas entity which is into doing this investments as an activity, it can fall into the financial services activity definition. If that happens, financial services activities are only allowed when it is done through an Indian entity which is regulated for those financial services activity, and then it has taken a permission to go abroad and do the similar financial services activity. I understand that there is a law which allows a non-financial services activity today to go ahead and also invest into financial services activity. However, that has not been actually activated by RBI. This is one of the long-standing issues between RBI and the government. Government has allowed something, but RBI has very clearly told that a non-financial services activity entity, they would not allow it to do financial services activity outside India. What exactly is financial services activity again has not been defined within the OI rules, and there are two views on that. One view is saying that no, you are supposed to do some actual financial services activity with customers, and the other view is that no, it also includes any investment activity. If you go through the rules, essentially financial services, there is a master direction on financial services activity by the RBI, which is essentially where they have brought out what financial services activity financial institutions and banks can give. In those, one of those activities is of investments in stock securities, marketable and unmarketable securities. So now this is where the problem lies. In our view, if you are investing abroad, then you cannot do treasury management activities out of those funds. The intent of RBI is that if you have gone abroad and made profits, you may utilize it for your business purpose, which you have stated when you went abroad. If you are not utilizing it, then you can send it back. That is why the APR form captures what are the amounts which you have remitted back to India by way of, say, dividend. So I think that's where my view stands. Yeah.
Which one is this?
Rutvik bhai, there is one difference of opinion with the new OI regulation coming in. Any Indian company with a 3 years of profit, 3 years of track record of profit can create a company outside India which carry out this investment activities. Now the authorized dealers have started allowing the same. So taking the new regulation where the new Indian companies per se can invest outside India, then this company which is already having the reserves, where the core activity may be of their pharma or whatever they are, from where this surplus is being generated, and if the surplus fund is invested in this money market or debt mutual fund, what prohibits that?
That is what, the initial purpose for which it has gone. Yeah.
Very interesting thing. You see, this August 22 regulation permitted a non-financial company to invest in a financial company outside India. Unfortunately, I am one of the culprits who made this possible. But the problem, you see, what was the case which prompted this? There is an Indian auto company which sells automobiles in Africa. It is not a financial company in India. You cannot sell automobiles without having a finance company. Okay? Here everybody, you look at anybody, Mahindra, Maruti, BMW, Toyota, everybody has got a finance company. So this is not possible. Okay? Now somebody which is a hospital in India, Apollo, wants to set up a hospital and insurance company outside India. Because, in US there is an organization called Kaiser Permanent, which has made a model of this, that you run a hospital and you also give insurance. Okay, they want to do this. But you are a hospital in India. You can't set up an insurance company outside India. So because of this, what is not mentioned there is, a non-financial company can set up a financial company if such financial company is needed for its core business in India or outside India. Now immediately, so this part they left out, okay? Like it happens in, now what happens is, you see the billionaires are a dime a dozen in India, okay? You see every city that you look at in Ahmedabad, you will have dozens of people. So people make whatever investment, then sell it off, pocket a few thousand crores, and then now they want to run a family office. Now India business opportunities, they want to explore outside India. Now if you permit this, then what will be the extent of capital outflow? Now dollar is 100, touching 100, will be touching 100. Can government permit this? Everybody will take the money outside India. Who wants to hold the money in a depreciating currency? They will all take it outside India. So therefore, informally, if you go to a bank with this kind of a request, the banks are not going to remit it. So better you advise people that don't try to do this. No bank will remit this. Not even to IFSC. Some applications have been made, I believe, but no permission has been given. That is the first part of it. The second part of issue is, Now, yesterday, day before yesterday, the question was raised in RBI. All this foreign investment, about 200 odd billion dollars of foreign investment that has been made out of India, what are we getting out of it? Are we getting any dividend? Are we getting any income out of it? Nothing. Now, the second question is linked with that. There is a company where you have made foreign investment. Now, that company has made profits, has built up reserves, has enough wealth, but doesn't want to bring back to India, wants to invest it. Now, every company does treasury management. Every company has got a treasury. Because treasury is what? Treasury is basically matching your inflows with your outflows. Isn't it? So where to get and because inflow outflow will not be evenly matched. How do you fund your inventory and so on? And so you cannot think of a company without a treasury. Even the panwala who is sitting outside this building will have some kind of a treasury management, where to borrow and what to buy and how much inventory to maintain and so on. But what these people are thinking is that you have now built, let us say, 200 millions of reserves. I don't want to send it to India. How can I retain it here? Because it is sitting in the bank, this thing, in the bank balance. So can I do? Now, yes, you can do it. Treasury basically means if you can justify it as treasury management. But if you invest it indiscriminately in financial assets, if you invest in immovable property, it is not permitted. Tomorrow somebody may come after you. If you invest in financial asset, then you run the risk of becoming a financial company. If you meet 50-50, that test of NBFC. And now the regulation says that whether you are a financial company or not will be determined very clearly according to the Indian rules, not rules of there. So you run risk of that. So if you want to do this, treasury activity, what is normally treasury? Treasury is if you are investing, you invest in short-term, secure things. You don't invest in equity. Nobody invests in equity as a part of treasury management. You basically invest, as I have rightly mentioned, money market, liquid debt and mutual. There is no any other. You keep it in the bank or you invest in this. Don't take any, you cannot do any risky this thing. You cannot do long term because treasury is essentially short term.
Yeah. Thank you, Rajesh bhai. Thank you, Mohanty sir.
Thank you, sir. We move on to the next case study.
Yeah. Next case
So
study.
the next case study is investment through Gift City. Rajesh bhai, this is hot
We are
topic for
sitting in
Ahmedabad.
We are talking about Gift City, and the best part is no approvals being granted. So as rightly said by Mohanty sir, ke Gift City wants to develop, wants to start this family office and all, but the central office, Reserve Bank of India is very clear. The government is very clear. So Reserve Bank and government are now in the current one and the same.
Sometimes their views differ. Now this is the matter because this investment rules are now made by the government.
Yes, the Section 6 has been
Section 6 amended. It was amended in 2015.
Yes.
It was given to effect to in 22. in case of FDI in 19 only. Correct. But it was amended in 15 finance bill.
So the government is very clear. So we have seen from 2004 when you take $25,000 and put it into the ocean to 2022 OI rules where within 6 months if you do not use, you bring the money back to India. Naya Bharat, Nai Soch. So what we will do is, sir, as on today, the Gift City allows the same, but the government of India doesn't allow to remit it. So we go with this particular answer.
Yes. If the bank is remitting, then you remit, but the banks will not remit. Because technically it is permitted.
Next.
It's yours only, sir.
Yeah, we move on to the next case study, which is in the delay in capitalization. Case study number 13. Monty sir.
Kaun sa?
1313.
Sorry. Mohanty sir.
See, the question is that here, when should the reporting be made? When should the FC reporting be made? When you are subscribing to the articles of association or when you are making the first remittance? So this is basically the question. The question, the view that RBI is taking now is that when you are subscribing to the articles of association, it specifies a capital. Okay, you might be, in India, how much? It's some 10 rupees share you have to buy, something like that.
1 lakh minimum.
1 lakh I have to buy to subscribe.
Yes.
So in some jurisdiction, this may not be there. So that is why the problem for RBI, that you can form a company without spending a single penny into the company. But if you do this, at least you are mentioning the capital, that the company will have so many shares of such value. So RBI is saying that we will treat as a commitment. Not as deferred payment, but it will treat as a commitment. You say that no remittance has been made. So what comes out of it is that you form FC when you are subscribing to the articles of association, even if you have not put in any money, even if you have not made any remittance. So in this case, what you do is that you file an FC, pay LSF for compounding, and then you make the remittance.
But sir, what is being practically observed now is that 30 days is not given over there. So because on the day when I go and sign the memorandum, I am in an overseas country, that day I cannot file Form FC.
No.
That 30 days has to be there, and generally we have seen 90% of the case, this non-fund based limit, LSF is getting attracted, and till that time, my next immediate transaction doesn't take place.
You see, when you have filed when you have signed after that you have 30 days of time.
30 days.
Within 30 days you cannot do it.
Within 30 days you have to file Form FC, along with there is a fund-based, non-fund-based agreement what they prepare. Every authorized dealer has created their own style and mechanism to report, because there is no remittance which has gone. So all this process takes little time. Earlier it was okay, all the paperwork are ready and I am remitting money, and from that day 30 days was getting triggered. Now from the day of that subscription page where I am signing, sometimes the company formation takes little longer time.
You give me a note on this.
I'll give you the note.
Or if you want, you can go and meet people in RBI.
Okay.
I'll tell them.
So to the answer yes, there will be now 2 FC form which will have to be filed. One is a non-fund based and one fund based when the remittance is made.
Right. So sometimes what I say is that if you have time for getting these things amended, please go ahead and do it. There is no problem.
Yeah.
So many times the practical option which people choose is that pay some LSF and close the matter.
Yeah, I think also one point to be noted here is very important from the old master directions on ODI. Old master directions on ODI actually had a very unique formatting error, where what Rajesh Bhai referred to, where if you read that old master direction, it comes out that you can make Form FC or at that time Form ODI filing within 30 days of the undertaking the financial commitment, fund-based or non-fund-based. And in that kind of scenario, we had actually had a case where there were a series of guarantees which were issued, and all the filings were done within a span of 10 days, 15 days or so, considering that formatting error. That compounding or the LSF or even the compounding fee was coming out into a huge amount, because guarantees were being issued like in millions of dollars. This is where this formatting error was pointed out by us to RBI at that time, the CGM. It was, I think, during those COVID times, so we had to do it all online. And we mentioned to them that this formatting error, if you read in the master direction, though the law is very clear that on undertaking financial commitment, Form FC has to be filed. Banks are generally now asking that you intimate to them, because as Rajesh Bhai said, it's a chicken and egg situation. What should happen first? But they are saying that now you first intimate them and then undertake that financial commitment of subscribing to the memorandum and immediately supply it to the bank, and they will issue the UIN. However, wherever there are cases where these kind of LSFs are being attracted now for those past transactions, we did mention this to CGM, and CGM recognized it and deleted the whole of the compounding fee, because they had a formatting error in the master direction. They appreciated it. So this is something which must be kept in mind, but that 30-day limit was actually never there. It was a formatting error under the master direction. Today also, if you read the law, and they have been cited here in the query itself, nowhere is it said there is a 30-day time limit. It's on undertaking financial commitment itself. Genuine issue is there that when do you subscribe and when do you tell the bank. So tell the bank, intimate them that we are doing this, this is the purpose for this is the business purpose. Everything you mention to them, and then go and do it and immediately file the Form FC.
How much time do we have? Okay. Right. So, yes.
Who has subscribed 60 to 70% of the foreign entity, but the filing is not made with the AD banker and nothing has done. So in the similar case, the company A name is replaced by an individual who holds a share in the foreign-based entity. So technically, let's take an example of the Dubai. So Dubai allows, like, when you form a company, it's allotted. So he has formed a company in Dubai in which he holds 60% of the share. However, he has not made any investment in the company through the banking channel or any other channel. 40% partner, who is a non-resident of the Dubai company, has infused funds in the company. Now it's assumed that 4 years has been passed away. Now there are two options: that Indian counterpart want to resign from, relieve from that company. So what are the available sources, like whether he should go for the Form FC for non-fund based, then the fund based, then the sale of shares. This is the option one. And the option number two is he can directly switch from the shares.
Question is basically that a resident individual has committed to invest 60% in a Dubai company and 40% a local partner. No money has gone from India. The company is existing. The other guy has put in 40%. Has this person been getting anything from the company? Any dividend, income, salary, anything? Okay. And does he have any liability in respect of the company? Now, by agreeing to contribute to 60%, has he committed anything for which there can be any legal action? Or? The second option is always better because we don't understand what kind of liability he has created, whether he can be prosecuted for anything. He has already lent his name. His name has come in some official record. So that... what is he?
As per Dubai law, it is the other person who is the responsible. But for my India law, he is equally responsible.
We don't understand Dubai law. You see, always like a police of a state are helpless in another state. We don't know. We don't know about Dubai law. So here what is better done is that since the name is figuring, you go to RBI, whatever RBI decides, RBI may say that, okay, it's all right, you don't need to do anything. Or RBI says that you complete, and then since there was no money, then, because once an EIN created, it has to be struck up also, disinvestment has to be done. So whatever view RBI takes, you keep them informed. Otherwise, you can continue to sit. There is nothing on record anywhere. There is no EIN. Either you go through that entire process, or you sit quietly. If you have enough risk appetite, sit quietly, because you see, your name is figuring in Dubai. There is nothing, you have not created any record in India. Yeah, I don't know. You see, your name, how you created in Dubai without paying anything, and how you will remove without paying anything, I don't know. And why the name was created, what a liability you have created in the process. By lending a name is an important thing, isn't it?
And yeah, and just to add, I'm so sorry, Rajesh bhai. Just to add, I think most probably in the accounts it will be shown as a shareholder of 60%, and receivable from shareholder will be showing in the accounts. So technically he is liable to fund that 60%, which has not done it till now. Correct? So in those kind of cases, actually there is a liability existing. Now, as Mohanty sir said, the whole process is very difficult and painful, but records would have come to India also. So be careful of that.
So just on a live case, what we completed was that this person was made aware only because under the exchange of information, the data has come that you are holding the shares of a Dubai company. What we did, we took a valuation on the day when this share subscription was signed. We remitted the face value because today the value of the company has gone big. We remitted the money, we filed Form FC, completed the administrative procedure and then applied for compounding and got it regularized. Because getting regularized is a better option rather than ignoring, because there will be two wrong sides. One, you lend them name without giving any money, and tomorrow you are now withdrawing your name without taking the due share which is due to you as a 60%. Although you are in a loss, but whatever. So please, option one is better. Regularize. Yes, over to you.
Okay, so now I think we are done with the case studies, whatever we had. In the interest of time, what I would request all participants, my fellow panelists is that if they can share their practical experiences for a few minutes, so that the members are aware that what are the live case studies, what is happening on ground, especially relating to this FDI from Chinese companies, thanks to the relaxation, post-relaxation, whether are we seeing more investment proposals being cleared by the government, or what is the intention? So if you can share some practical experiences, would be helpful for the audience.
2 days back, there was a meeting at DPIIT about this press note 2. So basically, they are going to come up with this notification that 10%, which was informally, some of the banks were taking 10%. That is, Chinese beneficial interest up to 10% will be in order. The government permission requirement will come only if the beneficial interest is exceeding 10%. Now, this is something that they are going to grandparent the earlier investments which have happened. Although, as per the earlier press note 3 of 20, the position was that a single Chinese beneficial share will require government permission, the way the words were used for that notification. But now the government is saying that gradually there was a lot of discussion. Some banks started taking a view that up to 10% is okay. Government informally also said. So government is going to say that we will sleep on those issues. We will not prosecute on anything. They will be simply grandfathered. That is number one. But they are not going to give it a kind of written this thing. Only thing is that they will accept it, and there are 2-3 other points. I'll just. Then this 60-day, what all industries will be covered under that, that is going to be notified by the government, that where the industries will be under the fast track. Then the reporting of Chinese investment, that is up to 10% and so on, will commence. Government will give whatever reporting format, platform, etc. To be done. Then how exactly to calculate beneficial ownership, particularly in multi-tier structures. X company is owned up to 50% by a company, that is owned by 25% by a Chinese company. In those cases, whether it will be multiplied successively, that is something which the government will clarify. So this is what it is. So basically the situation is like this. If it is Chinese beneficial interest, Chinese, Hong Kong, Macau, etc., beneficial interest up to 10%, it will be under automatic route. If it is exceeding 10%, it has to go to the Government of India. In certain cases, they will prescribe a fast-track route where permission will be granted within 60 days. So this is how, and reporting and other things, the government will come up with the format, platform, etc. So this is how it stands. Anything else?
So on this Chinese part, we have two approvals. One was in 2020 when this notification banning Chinese people coming in. We were into the live case of a joint venture in an automobile sector where the back-end spare parts were being to be manufactured in India, where Chinese was my 50% partner. After the notification, everything stopped. So we went through the whole procedure of central government, DPIIT, met the undersecretary, gave them the report, okay, why this investment is important. The spare parts can only be procured through the technical know, which is only available with the Chinese people, and it will only help my Indian automobile sector. And they rejected my approval twice application, but ultimately after a span of 2 years, they gave us the approval. And second case, before this 10% notification coming in, it's in a public domain, so I can share. Then entertainment company got an investment of 27% from a UK-based company. But in a UK-based company, there was a Chinese investor. So on the due diligence, prima facie, we felt that we don't require approval because a UK company is making an investment. At the last fag end, on a due diligence, we came to know, because they were the investor who was doing the due diligence of my company, so we never did the DD of those company. But ultimately, it turned out that they had a Chinese investor. So we went to central government, DPIIT, explained the whole scene, and we got the approval. Yes, the UK company can invest into India. They took the report from the MHA, and then they concluded, yes, it's a fit case to give the approval, and the approval was granted. This is all a scenario prior to this coming in. Investment was more than 100 crore, and the investment by the Chinese in those constituent company was about 10%. So it's better to go for the approval and get the approval.
What will happen now in the two cases that you mentioned, the first case perhaps will be put under this fast track route.
Yes.
So you don't have to again rejecting. And what I see is that for this, there was this Foreign Investment Promotion Board, which they stopped, dismantled. They are again going to introduce this because now FDI has turned negative, so they are again going to introduce it. So this will be under fast track route. In the second case that you mentioned, that 27%, there they will have this computing of beneficial interest.
Okay.
So your UK company is investing 20%, and in UK company there is a 30% investor. So 30 into 27 will become 6%. It will fall under 6 or 8%. So that will be introduced here. Okay. So if both your cases will now onwards, these kinds of cases will be better.
I think only to add on this Chinese investments part, the kind of sectors where they will be doing an expedited clearance is provided in the press release. It is not there in the press note 2 of 2026, but it has been provided in the press release. Obviously, none of this gets actionable until there is a amendment in the NDI rules. So that NDI rules they are expecting, and that's what I think Monty sir was also referring to. One more important point is that press note 2 of 2026 has replaced the wordings of press note 3 of 2020. Where there was a mention of person or citizen situated in land bordering countries, which means that even if an NRI who is situated in, say, let's say, or resident of Hong Kong was coming under Press Note 3 of 2020 requiring government approval. Thankfully, now those words have been removed, and they only talked about a citizen of such country or an entity of such country or controlled by citizens or entities of such LBCs, meaning land bordering countries. So therefore, we now have a better way to say that if this language comes into the NDI rules as an amendment, citizens of other countries, including India, who are situated in these land bordering countries, let's say a UK citizen who is resident of China, can still invest into India as per the wordings which are now concerned. So let's see now, final verdict will come when the NDI rule amendments come in.
Any other specific experience you would like to share? Yes. I think. Yes. Yeah. So I think, yeah.
this will not form as a regular mode of investment as per the ODI regulation and hence will not be permissible. See, overseas has evolved in a big way the mechanism, whereas in India we still have the FEMA regulations, we have rules, regulations, and we have to abide by it. The easiest way we tell the clients is if you do not want to adhere to the FEMA regulation, become an NRI, so that FEMA will be out of it. Otherwise, if you are a resident of India, you have to comply with all the rules and regulations. And this structure will not be permissible. Same thing, Government of India wants to tax me for crypto at 30%, but still the Reserve Bank of India is not clear about the permissible, not permissible. So this is a situation we live in. Yes.
Yes, friends. Thanks a lot. Before giving the formal vote of thanks by our coordinator, C.S. Sanskar Jain, as a chairman of ICAI Ahmedabad, I request one or two or the three participants who can give their feedback about the FEMA series. I love to invite you on the dais about your experience and yes, please come onto the dais and give. Yes.
So, to be very honest, let us first give my introduction. I'm a chartered accountant and working in the industry since last 10 years. We have an office at Dubai. We also cater some clients for Dubai. So, I assume in a way that I know many things which are governed by RBI and the FEMA and the business ends. So, it's an honest opinion. In last 10 days, we have learned many things, and with these learned things, we are able to crack the two clients on the very first meeting. Very first meeting, they are so convinced about our feedback, what we have learned, what the faculties has given their personal opinions, the case studies, and it helps a lot. So I again request this should be conducted on a quarterly basis so that we can get more insight from the faculty. We can also have something like weekly bit that we have started for the AI. We can think something of a monthly for a few panelists. They can come and just share their knowledge. Thank you so much. Thank you so much, Rinkesh Bhai, for hosting such a nice web seminar. We love to hear from you.
Thank you. Thanks a lot. Quarterly तो नहीं बोल सकता हूँ, लेकिन yes, definitely yearly तो try करेंगे. I started this initiative. Let's see who comes next and who will take care of this. But definitely, that's why, to be in touch, formal WhatsApp group we have created today. And you can post your queries, and we will try to have an interactive discussion. And any help is required from the branch side, we will definitely love to do. One more, anyone would like to share? Anyone? Yes, sir, please, sir.
It was a pleasure to have such kind of seminar over here, and all the faculties were fantastic, honestly. Always we found that in some of the cases that the time allotted was too short, and the kind of interest was created by the faculties was so fine that we cannot even dare to leave any one word or a sentence spoken by any one of them. So this was my feeling. And even today's session, I am so much impressed about the kind of experience what they have. And they have shared so nicely with their own views. And it gives us a clarity as to this is the matter, how to deal with it. So I believe that the subject is very, very big, though the sections are very few. But the kind of directions what have happened and the way how the act was evolved over the years, that shows that we need to have complete knowledge about this. Otherwise, this is little bit risky to practice even on. And we have to be very careful in making sure that every transaction is something new. So we have to read each and everything and then give the advice. So what I carry from this conference is that This is absolutely a fantastic area to practice, but it needs a lot of cautions, a lot of care to be taken, and complete updation day to day is required. So this is completely a fine subject, no doubt about it, but you need a lot of knowledge about it. Thank you so much.
Thank you, Nalin sir, for giving kind words and feedback on this matter. I really appreciate. Friends, this kind of words and this kind of participation motivates us for long, giving you more and more new things, or I can say refreshing the existing stuff. Again, I request, if anything would you like to have to be hosted at the Ahmedabad branch, feel free to connect me or any of the managing committee member. We will love to host for such kind of seminar. I request CA Sanskar Jain for formal vote of thanks.
Hello. Good morning, everyone. As we come to the conclusion of this 11-day FEMA series, first and foremost, I would like to thank our esteemed, session chairman, Mr. Himanshu Mohanty sir. Sir, your presence is, what make this stages valuable, as your perspective, how RBI thinks and how we can take the matter with the RBI and how we can solve the issues which are coming up in our day-to-day series, sir. So, and your guidance with respect to the matters with the RBI and everything, sir. So, thank you so much for your guidance and support, sir. Ahead, I would like to thank our esteemed speakers, CA Rajesh sir and CA Rajesh P. Shah sir and CA Rutvik Sanghvi sir for their expertise and insightful sessions and guiding us with the real practical world and how these queries need to be taken with the people who are in with the right place to give the answers. So thank you so much, sir, to giving us this insightful sessions. Now I would like to thank to our moderator, CA Soumya Seth sir, and our coordinator CA Jay Shah, and all those people who are working behind to make this event so successful. As we can see that in 11 days we have learned so much. So it's really appreciate for the people who are working behind so much, tirelessly they are working for this 11-day FEMA series. So thank you all those people who are working behind this. So really round of applause for them also. I would like to thank our branch chairman also, CA Rinkesh Shah, and all the managing committee members who really make this type of events and guide all the participants through with all the knowledge and providing us with such an insightful sessions. So thank you, sir, for this opportunities to learn from these members. So lastly, I would like to thank all the participants who make this event really successful. Your presence, what makes this event successful. So thank you all. And at this note, we conclude this 11-day FEMA series. So thank you so much once again. Thank you all.
Yeah, before conclusion, just one small request that already WhatsApp group is created. We have put the Google feedback form also. So please spend 2-3 minutes for the feedback form. Thank you. Thanks a lot.